comes into force. And payback time. The ECB lifts its ban on bank dividends, but caps payouts at 15% of profit. Matt?
So we do see futures higher across the board as we await the Fed meeting. Will be interesting to see what the Fed does, because the dollar is already so weak, and if they give, I guess, more forward guidance, more information about their bond buying program, if they're more active, I guess it could weaken the dollar even more, which is great for euro investors, especially from overseas. Here you see the live trade on the global macro movers screen. The left-hand column is equity indexes. Bloomberg style actually is indexes with an X. We have to get that changed. I don't know how the programmers got indices through. In any case, the FTSE comes out of the gate up 0.2%, 0.3%, and gaining this morning. We had futures on the continental equity indexes gaining as well. So if and when they open for trade, they will no doubt rise. Here you see the DAX and the CAC 40, both up about 0.4%. Even the IBEX showing gains this morning, about 0.1%. So European markets higher across the board, even as I should say, governments around Europe are having to make tougher decisions on tighter lockdowns around the holiday period. Germany going into its tightest lockdowns thus far. Starting today, you are no longer allowed to drink alcohol in public, which for Germans is a huge infringement on liberty. Joining us now is Peter Kinsella, Union Bancaire Privé, Global Head of FX Strategy. And I wonder, do the markets completely look through these tighter lockdowns, Peter? Or have they been priced in already?
I think they're looking through them. It's pretty clear. If you look at what's happening with respect to the vaccine developments, with the Moderna and Pfizer and so on, markets are basically in a place where they're saying, okay, look, we're going to have a lockdown for a little while, but the overall value trade is still going to kind of continue running, and consequently, they're just simply looking through the lockdown. So, with good reason too. I don't think we're in any way near sort of the bubble that people are talking about, and consequently, I think that looking through the lockdowns is definitely the correct thing to do, in my view.
And where does this leave the euro, Peter? The euro seemed to have been rising for a lot of this year on the back of bearishness around the dollar in markets, and also the ability of Europe to put together the recovery fund. All of that still seems to be in place as we go into 2021. So how much stronger does it get?
So I think if you look at the euro on a trade-weighted basis, it's risen a bit, but not by a huge amount. I mean, most of the euro sort of rise has just been a reflection of dollar weakness, and I think that the question is, one, whether the dollar will weaken or continue to weaken, and two, whether the ECB are kind of happy or kind of can do anything about euro appreciation. So if we look at the dollar leg, certainly there's room for the dollar to fall further. It's very, very heavily overvalued. We've got a massively widening current account deficit, which will probably widen quite aggressively in the first half of next year. We've got a gargantuan budget deficit in the States, a Fed that's printing money. I mean, all the signals are there for the dollar to continue weakening. So when we've had this type of combination before, the dollar has subsequently weakened by between 20 and 30% on a trade-weighted basis over the subsequent years. And that the dollar could easily weaken by another 15 to 20% on a trade-weighted basis over the next 18 months. So it's by no means impossible. So that's definitely going to drag the euro higher. And I think on that basis, then the question is whether the ECB can really do anything to prevent that. And in my view, the answer is no. It's not like they can cut rates any further. They've done as much as they can do realistically on QE. And really the only extra thing they're going to do next year are the possibility of further negative rate tenders. That's a growth-enhancing measure, and certainly the euro would benefit from that. So I think that it's like the old saying goes, it's our dollar, but it's your problem, and that's how it's going to be next year for the ECB.
That's a great quote. Our dollar, but your problem. What do you think we'll see in terms of emerging market currencies? We've been talking about that a lot today. We've got on the MLive blog, we've got some carry trade recommendations in terms of a macro view out from Simon Flint. And of course, EM is going to face some headwinds that developed markets won't.
I think there's two things to say there. The first is if you're talking about going long carry trades have not worked structurally, over a longer term period since 2008. Right, so if you're talking about setting up a carry trade, sort of, any systemic carry trade, they simply haven't worked for a long time. The second point is that EM carry is way lower today than it was in 2008, 2009. So, and that's both in nominal and in real terms. So I think that on that basis, jumping into EM looking for a carry story, it's not all that compelling, in my opinion. There are pockets of interest, so the likes of the ruble and the Mexican peso could benefit from much higher oil prices. And you've got central banks which have nearly indicated that they're at the end of the line in terms of the rate cutting cycle. So that's fine, and I think they'll do reasonably well. I'm a bit skeptical about other EM currencies. However, I think the Turkish getting into a long lira position is possibly not the best way you're going to I'd say allocate risk in a portfolio, just given the fact that CBRT is really sort of under the guise of political sort of influence and interference, and that will continue to be the case in 3-6 months from now. I can easily see sort of the CBRT coming under pressure again from the authorities there to reduce rates. So I certainly would have a healthy skepticism towards long lira positions. I'd say probably one of the EM currencies we like the most is the Chinese renminbi. You're continuing to see a decent yield pickup over developed market equivalents. It's got a pretty low correlation with other markets. And likewise, I think that what's great is that you're seeing large inflows into both the equity and the bond markets in China, which have effectively trebled this year from levels of around $50 billion per month at the beginning of the year to current levels of around $150 billion. So I think that the overall macro picture in China is still a compelling one. I do anticipate that CNH and CNY will rally on the back of that.
Peter, we're getting some lines coming through from Ursula von der Leyen of the European Commission, of course. She's been talking about various things in the European Parliament, talking about vaccines and how close we are to that in Europe, but now also going on to talk about Brexit, saying, I cannot tell you if there will be a UK deal, says Brexit talks have a path to an agreement. There is a path to a UK agreement now, according to Ursula von der Leyen. She cites the same old stories, fisheries and level playing field are still outstanding. They are the two issues. Just looking at where we are on the pound, it seemed as if it was just going to push up towards 135, now back 134.93. We have seen a bit of a spike up this morning, though, Peter. Your expectations, I mean, what's the timescale you're looking at here?
Okay, my expectation is that they're going to get a deal. I think in terms of timescales, I wouldn't be surprised if they if these negotiations go on for another week or two, and we kind of get a deal by early January. Sort of being signed off, and with the T's crossed and the I's dotted. So in terms of timescale, within a week or two, I would think.
But you think that they can fudge the December 31st deadline?
Well, I think, look, even if we go over by a few days, that's not going to be the end of the world. It doesn't surprise me that these these talks are going on the way that they have done. You know, standard negotiation theory tells you that in any negotiation, the side with sort of the least leverage always waits until the very last minute before they make concessions. So it doesn't surprise me at all that we're seeing sort of the UK move on, you know, on this, you know, the evolution clause and all these other things. It doesn't surprise me in the least bit. And what we know about EU negotiations is that they do tend to go to the last minute. So what we're seeing at the moment is very standard and very much to be expected.
All right, Peter, you're going to stay with us. Peter Kinsella, Union Bancaire Privé, Global Head of FX Strategy, will continue talking currencies with us. Coming up, running out of time, U.S. lawmakers must reach a deal on stimulus before funding for federal agencies ends midnight Friday. Mitch McConnell says he's optimistic. More on that next. This is Bloomberg.
Welcome back to the European market. Open 11 minutes into our trading session, and European equity markets on the front foot. What is also on the front foot is the pound, just a little bit higher this morning, 134.89, up 0.2%. Ursula von der Leyen has now stopped speaking at the European Parliament, but she says the next days will be decisive on Brexit. I sometimes feel, she says, like we can't solve fisheries. It does seem as if they are still trying, though, to do so. Let's turn to the United States and stimulus talk there. Senate Majority Leader Mitch McConnell says he's optimistic the two sides will be able to complete an understanding sometime soon. He was speaking after a late-night negotiating session with House Speaker Nancy Pelosi and other Democrats. The aim is to finalize coronavirus aid in time so that it can be attached to a package of spending bills before funding for federal agencies runs out midnight on Friday. Peter Kinsella, Union Bancaire Privé, Global Head of FX Strategy, is still with us. Peter, we talked a bit about your view on the dollar. You seem, like many others, to expect the dollar to weaken. How much does the spending bill, how much does the avoiding these cliff edges and further stimulus for the US consumer, how much does that stick to the dollar narrative?
Well, what it does is that in a normal year, having sort of increasing spending, etc., would, you would think if it was spent on infrastructure, you would think that would be good for the dollar over the longer term. What we've seen this year is that U.S. budget deficit, or U.S. budget, U.S. debt has expanded by nearly $4.8 trillion. And not a single piece of rail or road has been built, right? It's literally just gone into consumers and it's been spent to consumption. So that's not necessarily good by any means for the dollar over the longer term, because it does increase the indebtedness of the UK or the US fairly dramatically. And that prevents the Fed being able to raise rates in kind of any kind of a real manner, over the longer term. Even a 1% increase on borrowing rates would effectively equate to around 150 billion to 200 billion in interest payments. So, you're not in a situation really where this, much heavier borrowing is going to be good for the US economy at this point in time. If we get it spent on infrastructure spending, yes, that would be good. But what we're seeing is it's just going for consumption and towards sort of consumer support. And as I said, that's a sticking plaster. It's not really a longer term cure or a longer term way of increasing or enhancing US productivity.
What happens when, these central banks surely are going to race to devalue their currencies, right? No one's going to let the Fed get away with weakening the dollar. How does the ECB, for example, strike back when you start to see 125, 130 on the euro?
Well, it doesn't. I think if you look at the ECB, the point really for them is that they're concerned about the rate of change rather than the level itself, right? So, we've had the euro dollar trading at 160, many years ago. The ECB didn't intervene then. They're not going to go and intervene now. I think the distinction really is, as I said, it's rather the rate of change that they're concerned about. But if you listen to if you read between the lines, between the ECB and between EU politicians, they're focusing much more on fiscal spending in the EU. Obviously, that starts with the recovery fund, and that's well known, and that's a good thing, particularly if it's implemented and rolled out next year, which we all hope it will be. And this will be the first time that we have a combination of fiscal stimulus and aggressive monetary stimulus in the EU. And I think that could be very, very good for the EU economy if it happens in a pretty effective manner and if it's rolled out quickly, at least on the spending side. And secondly, then, if you listen to what the EU is saying in terms of the tenders, they're continuing to roll out pretty much as much liquidity as they can towards the banking system and towards helping companies to refinance themselves at low levels. So again, this is all that the ECB is doing. It's doing everything it can, focus on the Eurozone domestic economy. Worrying about what the dollar does or doesn't do, is a secondary concern, and it's one that they're simply not going to be able to influence either.
Let me just take you to what's moving the euro at the moment then, Peter. We've just got some new lines coming through from France on the PMI side. These look to be really strong compared to forecasts, which were admittedly for services very poor. But French December services PMI rises to 49.2. That was against a forecast of 40. So that does seem to be well ahead of where it had been anticipated to be, almost in growth territory, which given where we are in the pandemic is maybe impressive. French December manufacturing PMI, a lot more in line, but still above the estimate, 51.1, a forecast of 50. How much do these kind of numbers matter to you at this point then, Peter? How good a clue are they as to the prospects for an economy? We're looking at the euro spiking up a little on some of this data.
Look, it's definitely important data, and certainly looking at the PMI data on the composite side, that does give you a very good idea of what GDP prints eventually do. So I think that the fact we're seeing these very constructive PMI data in the Eurozone in a broad sense, that is very good news for the euro, particularly from a growth perspective. I should say it doesn't surprise me all that much. If we look at sort of leading indicators, PMIs in China and the rest of Asia, they've been doing very well for the last number of months, and you're starting to see that spillover effect now in towards the euro. And certainly what we tend to find with the euro is that it does trade with a higher beta to global growth. And if global growth does surprise to the upside, which is my expectation, that basically is very, very good news for the euro and will drag it higher. So what we're seeing is very consistent with, broadly speaking, what I would have expected.
All right, Peter, thanks so much for joining us today. Great to get some of your thoughts. Peter Cantello, Union Bancaire Privé Global Head of FX Strategy on a day when FX really is sitting in the spotlight. Peter's going to be continuing the conversation with us on Bloomberg Radio at 9 a.m. UK time. So if you want to tune into that and you're in the city, Just do it on London DAB digital radio. Coming up, Volkswagen's board resolves a weeks-long conflict, but has the damage already been done? We'll speak with Bankhaus Metzler's Jürgen Pieper next about the stock that gained more than 7% in one session yesterday. This is Bloomberg.
We are enabling banks to pay within a certain threshold, so within a so-called guardrail, and this is a change with respect to where we have been up to today. So it's an important opening which has been broadly supported in the supervisory board and which recognize that we are moving slowly back to normal, although we are not in the normality yet.
And that was ECB Supervisory Board Chairman Andrea Enria speaking with Bloomberg's Paul Gordon. We're going to continue showing you snippets from that interview. You can check it out as well on Bloomberg.com. Now, Volkswagen Supervisory Board has resolved a weeks-long conflict between its CEO and key stakeholders. The carmaker's board now gives its full backing to Chief Executive Herbert Diess while granting some concessions to the unions, as well as vowing to keep the brands Lamborghini and Ducati on board. Joining us now is Jürgen Pieper, Bankhaus Metzler, Senior Advisor for Automobiles. And Jürgen, I think you'd agree this was a fascinating couple of weeks for shareholders. What does it mean now that Diess has the full backing? What have the Porsche and Piech families signed on to?
Yeah, the full backing, I would say, principally yes. On the other hand, what he wanted was an even longer contract until 2025. So I wouldn't say it's a 100% perfect situation for him. So in general, we are there where we were a couple of months ago. He went into this power fight, wanted more. Then he took the risk that he was in the end possibly fired. And finally, we come back to a situation where we were before that. So this was a bit a roundabout with Volkswagen being, took I would say a little damage. It was again like often in the past in the media and the press with this typical Volkswagen power struggles, power fights, and but in the end I think the outcome is fairly good for everybody, including Mr. Dies, who's there then for another 2.5 years, and I think this is fine. He is almost 65 already, so it's quite a normal outcome. But in this turbulent situation, I think it's fairly good for everybody, including
what about,
the Lamborghini.
He wanted to. Exactly, and I am, full disclosure, a big Ducatista fan of the Ducati brand and motorcycles. What does this mean for those peripheral brands, Lamborghini, Bugatti, Ducati, that Winkelmann clearly wanted to get rid of? Now they're going to keep. What difference does that make to the Volkswagen shareholder?
Yeah, it is. I think there was a potential to sell these brands. In the end, one must say that Volkswagen has too many of them. One of the problems of Volkswagen, I think, is that it's not just a giant; it's also an extremely complex company. And I think it would be good in the end if they would get rid of 1 or 2 or 3 of these brands, and also maybe for the valuation of the company, if you look at the Ferrari value, not to mention a crazy valuation of Tesla, but look at the Ferrari valuation, and if somebody looks at Porsche, at Lamborghini, at Bugatti, then you quickly come to the impression that Volkswagen certainly is undervalued. So for the valuation of the company, I think a spin-off, a sale would have been the better way.
Okay, yeah, we see the share price really moving aggressively higher over the last couple of days, 7% or so yesterday, another 2.5% today, Jürgen. The CEO said yesterday that he's pitting the Wolfsburg plant against Tesla in Berlin. That site, of course, under construction. That would involve, I understand, bringing down the time it takes to build a car, well, halving it. How achievable is that on the scale of production we're talking about at VW?
Yeah, this would be a great achievement. This is certainly the right direction, and this again shows that Mr. Dies in many of these things, I think, has the right attitude. He knows exactly where Volkswagen should stand or could stand at some point in time. But I think if you've ever been in Wolfsburg, I think it's the biggest industrial plant in the world overall, and with a very high unionization of people. I think 98% of the workers are in the IG metal union. So to change things there, to bring things forward quickly, I would say is almost impossible. But it's right that Dies addresses these things, that he says where Volkswagen should go and where they should stand at some point in time. So this is certainly the right attitude is there. It's extremely difficult, I think, to change things, especially at Wolfsburg.
Jürgen, you have a buy on most of the automakers you cover, Volkswagen, as well as Daimler, a hold right now on BMW. Can you explain that?
I think, yes, I hope. I think overall, I'm pretty positive for the sector. I think the third quarter has shown that it gave a signal how quickly the industry can come out of the crisis, out of the recession. This was already the case back in 2010, 11, after the financial crisis. Yeah.
Sorry, I've got to cut you off there. We're running into a break. Thank you so much for.
Welcome back to the European Market Open, 30 minutes into Wednesday's trading session. You see the Stoxx 600 here in Europe up by 0.9%. We do see broad gains really for across the European equity markets. The Xetra DAX in particular up by 1.4%. The auto sector doing pretty well. The likes of Continental and VW we've talked about this morning. US futures also point to the upside. So to some extent, London and the rest of Europe playing catch up with what happened stateside last night, but we've got US futures suggesting there'll be a little bit more upside. Matt, you've got some breaking news?
Yeah, well, we've got the PMIs coming out here in Germany right now. The German manufacturing PMI coming out better than the survey, better than the prior number at 58.6. So manufacturing doesn't look bad here. The services PMI also better than the survey and better than the previous number, but below 50. So 47.7 is the services PMI, which indicates a contraction, and you can expect that to be accelerated now that we're in this harder lockdown. 58.6, an expansion in the manufacturing PMI, and the question is, how does that look going forward? Let's get the Bloomberg First Word News now. For that, we go back to London and Laura Wright. Laura?
Thanks, Matt. President-elect Joe Biden is assembling the team to drive forward his ambitious climate agenda. Bloomberg sources say he's picked former Michigan Governor Jennifer Granholm as energy secretary. We're also told he's chosen Obama's Environmental Protection Agency chief Gina McCarthy as his climate czar. Germany is entering a hard lockdown today, closing non-essential stores and urging offices to shut. Chancellor Angela Merkel is warning the country faces a new peak of COVID-19 infections next month. It's raising doubts the country's lockdown will end in early January as planned. Australia plans to challenge China at the World Trade Organization over the decision to impose tariffs of over 80% on its barley exports. It's a further sign of deteriorating relations between the trading partners. The dispute process could take years to be resolved. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Matt, Anna.
Laura, thank you very much. Laura Wright here in London. Now, Europe is inching closer to starting its COVID vaccination campaign. Regulators will review the Pfizer and BioNTech vaccine next week, earlier than originally planned. The shot is already being rolled out in the US and in the UK. Meanwhile, the US FDA has found the Moderna vaccine safe and effective. That's ahead of Thursday's meeting where regulators could grant emergency approval for that one. So joining us now to give us a sense of where we are, Sam Fazeli, Bloomberg Intelligence Senior Pharmaceuticals Analyst, is with us. Sam, good to speak to you today. And given what we've just been through there, the summing up of where we are on the vaccine rollout, I was taken by a line from the Spanish Prime Minister today, Sanchez, saying we're at the beginning of the end of the pandemic. Does it feel that way to you?
Good morning, Anna. So does it feel that way to me? Well, yes. I mean, you walk around the streets, you still see people with masks, and we'll continue to see that for ages, and we keep hearing about shutdowns and lockdowns and schools, etc. But, you know, the sooner we start seeing friends, which I have got one who's just gone in yesterday to get her first shot in London, the more I think people will start having a little bit more optimism about really trying to end this nightmare that we've ended up in.
Well, yesterday I heard the term new variant, which kind of freaked me out, Sam. Are we going to see different strains of this virus, maybe some that the vaccine isn't capable of coping with?
Yeah, so I'm going to answer that in little sections. A new variant, this virus has had many new variants. That is what viruses do. They do not stay still. It's their job. It just happens as part of their nature and their evolution. And so it's not a surprise we found one. We found one in Scotland. We found one in Denmark. Then there was the D614G that came up ages ago. So these variants will come up. And of course, I can't answer the question whether there will be a variant that can escape the vaccine and antibodies that we've developed. What is good, though, is that if that, God forbid, happened, the technologies that we have for developing these vaccines, the mRNA technology, the Astra technology, the J&J technology, can respond rapidly. So that's at least one good thing, if that happens.
Sam, can I get your assessment as we listen to further lockdowns coming through across Europe? So we listened to Angela Merkel talking about how long measures might be in place in Germany. And of course, there's ongoing talks about many parts of Europe on that front. Leaving mask wearing aside, which might be something we just have to get used to for quite a long time, in terms of the really tougher measures, the tougher parts of the pandemic, closure of certain facilities and inability to see friends and family, how long do you think that is going to be with us in Europe? If you look at this really realistically now, are we talking springtime? What kind of horizon do you have in mind?
Yeah, so I think that to get to the answer, I would say by mid-year would be highly surprised if we haven't managed to get ourselves out of that. And the equation that you need to solve there, my favorite phrase, is that you've got to vaccinate the people who are at most risk, which of course we all know. So let's say that 30% of the population in Europe, 100-odd million people, we have enough doses. So it's all going to be about, will the doses get here? Will we deploy them correctly? If we do all that, we have to be really bad at getting this done if we haven't managed to protect them by the middle of the year, which means then we don't have to have these draconian, tough lockdowns.
All right, Sam, thanks so much for joining us. Sam Fazeli there, Bloomberg Intelligence Senior Pharmaceutical Analyst. Now, speaking of tough lockdowns, Germany has entered its hardest yet, closing schools and non-essential businesses, banning alcohol on the streets. We won't even be able to buy alcohol for a few hours on New Year's Eve as Chancellor Merkel attempts to stop the rise in COVID infections. The measures will be in place now until January 10th, but maybe even longer. Let's get over to Marcel Fratscher right now from the DIW here in Berlin. He's the president there. Marcel, this seems like the worst possible time for the economy to go into this kind of harder lockdown. So many retailers turning profitable for the year finally and are not going to be able to. Is the government capable of financing those businesses in such a way as to save them, or are we going to see a wave of bankruptcies as a result?
The German government is doing everything it can. There's hardly any country in the world that has put on bigger stimulus programs, helping companies compensate them for the costs or even for the revenues. But the honest truth is that, of course, a government can never compensate entirely for the losses, for the economic cost of such a pandemic. So clearly the German government has deep pockets. It has announced further stimulus measures starting from January. So it does what it can. But clearly probably one of the biggest risks for the German economy is a wave of corporate bankruptcies next year. The German government actually suspended the legal obligation to declare bankruptcy for companies this year. This is expiring at the end of December. Many companies are highly indebted. Many companies expect, and rightly expect, revenues to stay weak for much longer, and we actually expect a contracting German economy in the first quarter next year. So one of the big risks will indeed be a wave of corporate insolvency. I think it's not the question whether it's going to come, it's more the question when exactly companies will fail.
So is this the right measure now, Marcel? I mean, we've been in lockdown light since November. It feels like a lot longer than that, but it hasn't helped. Is this going to do the trick?
Well, the lockdown light has helped. It has not helped enough. And I think it's very important to emphasize that there's no trade-off between protecting people's lives and protecting the virus from spreading on the one hand, on the other hand, from protecting the economy. And we have seen already during the last few months that the German economy, that sales, for instance, in stores have declined by 50%. So the economic downturn already resumed in the fourth quarter now, starting in October. So the quicker Germany can stop the second wave of the virus, the earlier the German economy can restart. And the German economy did very well in the third quarter. The exports have been booming, consumption has been picking up. So the biggest challenge will be to stop the second wave of the virus. The earlier this happens, the better for the economy. And again, Germany's government is very resilient. It has the fiscal means to support companies and households. It has done so fairly effectively. But the honest truth is that Germany so far in the first wave of the virus has been doing a lot better than most of Europe. Now it's catching up with Germany, and Germany is suffering now the second wave as much and probably even stronger than other countries in Europe.
We just saw some manufacturing data out, Marcel, some PMI data that showed 58.6. That was ahead of the forecast. It's a very high number. That's manufacturing. Services is a different story, of course. You talk about how we are going to see bankruptcies. Where are we going to see those? Is this going to be very skewed towards the services sector, or is the manufacturing export engine also going to be under pressure?
Manufacturing has been doing better than services. Germany's big benefit are its exports. Exports had been hit in the first wave very strongly, but with China and Asia recovering, Germany's exports are actually doing well. So the problem is corporate investment and consumption, particularly in services sectors, social consumption. So events, traveling, going to restaurants, going shopping. These are the sectors hit particularly hard. So it's those sectors, and particularly smaller companies. And the structure of the German economy is quite different from many other countries. We have a very strong focus on mid-sized and smaller companies. Those are somewhat less resilient. They're usually much more reliant on bank financing than the corporate bond markets. We will see a number of failures, in particular, not just in services, but also among smaller companies, possibly also including the auto sector. This we will see next year.
All right, it's certainly unfortunate, but we hope the German government is able to nip this thing in the bud. Marcel, thanks so much for joining us. Marcel Fratscher there, DIW Berlin president. Hope we can get you back on for more on this soon. Coming up, fighting climate change. Central banks voiced their support for going green, but have yet to take decisive action. That's according to a new survey. We'll look at what needs to be done next. This is Bloomberg.
It's actually what you would expect if you're an investor, that the business that you invest in actually is by the book. If they're not, then it is fines, another fines, repeated fines, behavioral commitments. But there is the option eventually to ask for a divestiture, splitting up a company. I would not expect that we should go there, but as a last resort, I find that it is justifiable.
That was the European Commission Executive Vice President Margrethe Vestager speaking to Bloomberg. She was talking there about the business of clamping down on technology firms. Let's talk about another big theme of 2020 and into 2021 and beyond. Global central banks are voicing support for the fight against climate change, but most are making little progress in adjusting their policies to enable this. That is according to a survey by the Network for Greening the Financial System. Major central banks are being called on to use their massive bond buying programs, now being expanded to assist the recovery from the pandemic, to shift investment out of polluting industries. Let's talk now to Jennifer Wu, JP Morgan Asset Management Global Head of Sustainable Investing. Jennifer, good to speak to you. So that's about what central banks are doing. I also want to understand from you your assessment of what corporates in general are doing. And I notice you talk about in your notes the alignment or misalignment of a company's emissions trajectory with Paris goals. And I wonder if we look ahead to the earnings seasons to come and how, I sit here at this desk and we break earnings news and we talk about whether companies have beaten or missed expectations. And I wonder what we can be looking for in a sustainability sense to work out if companies are on the right path on that front as well. Give us your guidance.
Yeah, sure, Anna. So thank you very much for having me. Good morning. I think yesterday it was a pleasant surprise to see how the Fed came out and saying that it is going to formally join or has formally joined the network of central banks and supervisors for greening the financial system. And that is a alliance that focuses on, exchanging ideas and then really exploring ways for central banks and the banking industry to mitigate climate-related risks in their balance sheet. So I think that's a good development from a policy standpoint. Coming back to corporates, I think next year, what we're very much focusing on is as different countries and policymakers look to reset goals or renew their commitments, there is going to be a fair degree of realigning what a pathway should look like from a corporate standpoint. So we're expecting to see many more corporations coming out with their emissions reduction plans, targets, and what we should be focusing on really is not so much the end goal, which I think is going to be pretty straightforward for most companies, that about net zero as a end goal by 2030, 2035, but really around, whether these companies are able to define in their announcements near and medium term plans and targets that are realistic, that's achievable, and that, how they potentially could impact CapEx, as well as, how they look to invest in green patents and new technologies, et cetera. So some of those near term targets is what we're focusing on.
Which central bank do you think, Jennifer, has the most potential to affect change in this area? I mean, I know the ECB, for example, debates whether or not this should be its mandate, although Christine Lagarde is pretty clear about what she thinks, and she runs the bank. And even those who question the mandate, Jens Weidmann, for example, has said they need to check whether they're unintentionally supporting companies that are environmentally harmful or industries that are environmentally harmful with its policies.
Yeah, so I think all central banks can have a pretty critical role to play here, and they can be quite influential if they, allocate money to where it should be. This actually speaks to one of the problems that we have in the market, even from a private sector standpoint, which is the definition of green activities. Right now in Europe, we know that the regulators has a framework to define what should constitute as green activity, which serve as a guidance for all investors and even central bank to decide where they can allocate capitals to, but we haven't seen that across the board. I think the flip side of that is, even if we have this framework that tells us which activities are defined as green, there is still limited disclosure by companies So at the end of the day, companies could be in the right industry, but without disclosures around how much of their revenues is derived from these specific green activities, it's quite hard for investors or even central banks to be able to allocate capital in such a way that it's actually going to go to the right places. So I think next year the focus is, yep.
Yeah, no. So next year the focus is on that, maybe on getting further disclosures. I was just going to say, from Exxon this week, we've seen for the first time some targets to reduce their carbon intensity. But this is a business that perhaps within that sector is a little bit behind some of the other players within that sector in trying to take on the carbon challenge. How quickly do we need to see laggards in each sector catch up with the trailblazers, the ones that are in the lead, if you like?
Yeah, it's actually moving very fast. I think we're starting to see the difference between winners and losers, and the financial implication of that being priced in by the market little by little. And I think next year is going to be the inflection point whereby companies that don't have a plan, don't have a target, they potentially could be penalized because of lack of transparency, which creates more uncertainty for investors because we're not aware of exactly what the exposure is to potential climate transition risks if there is no transparency. So I think it's actually going to be much more evident next year who are the winners and who are not, moving quickly enough. But again, like setting out the target is the first step. I think next year we want to, from an investment community, I think the focus is going to be really on the near and medium term plan around how they're going to be actually going to reach those targets.
Jennifer, great to get some time with you. Thanks so much for joining us. Jennifer Wu there, JP Morgan Asset Management Global Head of Sustainable Investing. Up next, which assets will gain the most from a U.S. stimulus deal? Put that question to MLive's Christine Aquino. This is Bloomberg.
Welcome back to European Market Open, 54 minutes into your trading session. Stocks are making modest gains across the board, actually a bit better than modest now, as the US Congress moves towards a stimulus deal. The pound is strengthening as Brexit negotiators sound more positive about finding an agreement. Let's talk about some of these themes with Christine Aquino, Bloomberg Markets Live EMEA team leader. Christine, is it stimulus talk stateside that is pushing us higher here on European equities right now?
Yeah, it seems, Anna, that European equities are taking their cue from U.S. developments, which are considered positive. It goes to show that stimulus is still the main theme in equity markets and what's powering them to the end of this year, and possibly going to be a story that will continue to next year. Of course, that contrasts with worsening pandemic situation in Europe and even in the U.S. So, again, it's a battle between these two catalysts. At the moment, stimulus is winning, but it might only be a matter of time before investors once again come to grips with the reality of the current pandemic situation.
What should we expect from the Fed later today, Christine?
Well, Matt, I think a lot of people are going to be taking a look at the weighted average maturity of the Fed's purchases, because that, of course, feeds into the whole debate over whether the yield curve is going to be steepening or flattening next year. And, of course, that also relates to questions about the path for things, catalysts that could push yields higher, including inflation. And so it really is going to be something that people are going to be looking at. What sort of maturities are going to be focusing on, the Fed's going to be focusing on, are they going to be concentrating on the longer end of the yield curve, and is that something that is going to pin longer term yields down? Of course, you know, the Fed, one of the main concerns is probably going to be financial conditions, and they, of course, want those to be as loose as they could possibly be as the
Yes, Christine, thank you very much. Christine Aquino, who leads our Markets Live team in Europe. Yeah, WAM, weighted average maturity. WAM, as it was called by John Authers, our colleague here at Bloomberg. Nice piece by him on the terminal. That's it for the European Market Open. Surveillance is up next. This is Bloomberg.
as before Christmas, Mitch McConnell says lawmakers are getting closer to a deal. Investors await guidance from the Fed on bond buying. Extending restrictions, New York City mayor says prepare for a shutdown after the holidays. France imposes a curfew. London's tighter measures go into effect. And urging a moderate approach, the ECB lifts its ban on bank dividends, but imposes strict limits of payout levels. We hear from the chair of the supervisory board. Well, good morning, everyone, and welcome to Bloomberg Surveillance. I'm Francine Lacqua here in London. Now, we're just getting some figures from the IFO, so let's have a look at what that means. I think the IFO Institute numbers don't take into account the latest lockdown, so it'll be a good indication of what we did before lockdown, but of course it doesn't take into account what we'll see in the next couple of weeks. Now, before we get on to IFO, we also have Euro area December manufacturing PMI, 55.5 instead of the 53 that we forecast. There is positive news not only on the stimulus, of course, it's a Fed day, so watch out for anything in terms of assets bond buying program that changes on the Fed. And we're also hearing some positive noise out of Brexit. So I think we have the IFO Institute figures. I don't know if we can get them to you. If we put them on screen, then I'll bring them to you. But again, a good indication exactly of what we have seen since lockdown. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Good morning, Francine. President-elect Joe Biden is assembling the team to drive forward his ambitious climate agenda. Bloomberg sources say he's picked former Michigan Governor Jennifer Granholm as Energy Secretary. We are also told he has chosen Obama's Environmental Protection Agency Chief Gina McCarthy as his climate czar. Now, crossing over to Europe, Germany is entering a hard lockdown today, closing non-essential stores and urging offices to shut. Chancellor Angela Merkel is warning the country faces a new peak of COVID-19 infections next month. It's raising doubts the country's lockdown will end in early January as originally planned. Now, the UK is going ahead with plans to ease coronavirus restrictions over Christmas. That's despite mounting pressure to stop people mixing indoors over the holidays. The government is expected to set out stronger guidance on how to keep elderly relatives safe. The Daily Telegraph reports that may include asking people to self-isolate before joining other households. And Australia plans to challenge China at the World Trade Organization over the decision to impose tariffs on over 80% of its barley exports. It's a further sign of deteriorating relations between the two trading partners. Now the dispute process could take years to be resolved. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. Now let's kick it off with the U.S. Republican congressional leaders, and they're optimistic about reaching a deal on the stimulus package. Senate Majority Leader Mitch McConnell said, quote, "We're getting closer and closer." McConnell and other Republicans spoke with House Speaker Nancy Pelosi and Senate Democratic leader Chuck Schumer. Now, no word if Democrats have agreed to set aside two of the most contentious issues. That's aid to state and local governments and a liability shield for businesses. Well, joining us this morning is Ludovic Subran. He's chief economist at Allianz. Ludovic, a great pleasure to actually have you on today after everything that's happened over the last couple of months. If we get a deal, is it actually a deal that's too small to inspire the economy?
I think the U.S. desperately need this deal for three reasons. The first one is, there are just people that have lost their income, companies that are on the verge of a liquidity crisis. We've seen the number of bankruptcies spike in the U.S., so we just need to get money out. The second reason is because it would be just a great start for the Biden administration to try to get bipartisan traction on something as important as the stimulus. And the third reason is, I think, it's just something that could anchor a little bit more this idea that 2021 will be a lot about what, policymakers can continue to do to, bridge this uncertain period. So for me, this stimulus is very symbolic as well as very needed in the micro economy of the United States today.
Ludovic, when you look at exactly what it moves, so what does the what does the U.S. economy need right now? Is it support for companies longer term? Is it furlough? Are you worried about the amount of solvency in the system come 2021?
Look, there is 1 out of 4 companies in the US that in 2021 will have some type of cash distress. So working capital financing needs being a bit, reshuffled. So of course, it's all about bridging these treasury needs, this cash flow, these working capital needs. On the people side, and just, on this corporate side, it's all about also making sure the investment cycle restarts. If we just wait for the second half of 2021 to investment cycle in the US, it's far too late. So we need, especially, the US, it's 40%, 50% of social expenditure. So it's a service economy crisis. What we see is transportation, recreational, hospitality, all of these sectors are on pause. So we actually need to help those companies in particular. And this is why this stimulus is so important, and the part on the small businesses is so important. On the other side, you mentioned partial follow. Of course, this is major. There is no such scheme in the US today. So it's always been about handouts. And today, the issue is that the unemployment figures in the US are far, underestimated, because there are so many people that are not even looking for a job in the sector. Look at restaurants and hotels, or, anything related to the, big cities, workers that are going to big cities just for day jobs and stuff. So we need to find something that is also bridging the income gap. So it is either another check, or indeed it's putting something in place that is a bit smarter, like unemployment benefits, which is what this bill is trying to put in place. Not putting in place, but actually putting money into it. For me, it's very important that we get this right, because the risk of social unrest, but also the risk of the US economy being broken in the first quarter as the vaccine is being rolled out is very strong today, and we cannot afford that. Especially as you start, this new administration needs to make sure that they have a bit of momentum of growth to be able to pass some of the reforms that they've announced, and that they certainly want to make sure they put out of the door by the first couple of quarters in the United States.
So, Ludovic, what would be the first 3 challenges of Janet Yellen?
Well, I think the good news is that she doesn't have to worry too much about people, trusting the credibility of the U.S. Treasury, in spite of the numbers being crazy. The debt out of GDP in the U.S. is going to the roof. So I think she needs absolutely to find ways to distribute the cash. So execution. We've seen that it has been a big issue in the past couple of months, with the Trump administration not being able to actually get this out. The second is trying to find a way to bridge the liquidity gap for these companies. So tax moratoria, whatever can be done on making sure that some sectors are particularly supported, and not just so more targeting, if you will, to avoid windfall effects. And the third thing is to put a lot of money onto these unemployment benefit type of schemes to make sure that workers are supported, kept in the job, to avoid a massive spike in unemployment, as insolvencies will also increase in the US in the first quarter of 2021.
Ludovic, is there no chance that we get, sustained inflation in 2021?
I'm not very concerned about inflation. There will be a bit of imported inflation from supply bottlenecks. We see, for example, Chinese suppliers asking for increasing prices by 20, 30, 40%, because they are the only game in town. But we don't see any wage setting, price setting mechanisms, no overheating on this front. And I'm not concerned about monetary inflation. Just look at, the amount of liquidity and the lack of velocity of money. I'm not very concerned. There could be, slight overshoots, on food inflation, bottlenecks, but not something that could mean that the Fed will go back on its average inflation targeting policy. I think this is something that we can handle at least till 2023 without being worried too much.
All right, thanks so much, Ludovic Subrander from Allianz. He stays with us. Now, coming up, payouts are back. The ECB has lifted its ban on bank dividends, but with strict limits. We'll bring you the details next, and this is Bloomberg.
is critically important that the markets stay open in this time, as opposed to trying to take breaks in the middle. I think that that'll just push off the situation a little bit, but actually could create other pent-up issues if you do close the markets.
Economics, finance, politics. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now, the ECB has lifted its ban on bank dividends while imposing strict limits on payout levels. It says the continent's lenders should keep dividends and buybacks below 15% of cumulated profits for 2019 and 2020. Andrea Enria, the ECB Supervisory Board Chairman, told Bloomberg it's an important opening.
It has been an important day, yes, an important decision, but it is an opening to payments of dividends, actually. So we are enabling banks to pay within a certain threshold, so within a so-called guardrail, and this is a change with respect to where we have been up to today. So it's an important opening, which has been broadly supported in the Supervisory Board, and which recognize that we are moving slowly back to normal, although we are not in the normality yet.
Sorry, broadly supported, which does suggest not everyone supported it.
No, but there was a very broad support,
Okay, so the conditions that you're putting in place, that the limited dividend payouts you will allow on a case-by-case basis, are a bit stricter than those we're seeing recently announced in the UK. They're stricter than we're seeing in the US. Is that going to be a problem for the banking sector in terms of competing for investment, competing for staff and so on?
I don't think so. I mean, the important signal is the opening to dividend payments, and we also gave forward guidance that basically we intend to repeal this recommendation in September when, let's say, when it will come to an end. So we are going back to the ordinary situation in which supervisors will vet the dividend payments decisions by banks in the normal supervisory process on a bank-specific basis.
You could also argue that bank shareholders shouldn't really be getting anything yet, as long as the banks themselves are getting the benefits of regulatory relief, the benefits of the TLTROs from the ECB. There is that argument out there. I mean, why have you decided to go ahead and let bank shareholders get something?
Well, there has been an intense discussion in the last months, actually, in my board. On the one hand, we recognize that there has been a reduction in the uncertainty. So now the macroeconomic path is clearer. Our economies has been more resilient, and it seems that by 2022 we would be back to pre-crisis level. That's positive news, and that is what is pushing us to reopen to dividend payments. On the other hand, we still have not a lot of visibility on the asset quality trajectory going forward, on credit risk. And also, as you correctly said, there is a lot of support coming from the central bank, the supervisors, and fiscal policies, which is supporting also bank profits. And this is behind the recommendation to remain prudent in distribution for some time.
What about bonuses? What's your stance there?
Well, we are also prolonging our general recommendation to remain extremely moderate in the payment of bonuses. And also here, however, we are giving forward guidance that by September we plan to go back to the old normal.
The banks would say, look, they need to pay their staff. They've had a good year in trading for various reasons. And if they can't pay the bonuses, they risk losing their best staff to non-euro area banks. Does that concern you?
Look, we have never asked banks not to pay their bonuses. We have said to banks, be moderate in paying your bonus, consider paying bonus more in instruments, to have maybe more, let's say, postponement of these payments, and so be moderate given the conditions we're working in.
Well, that was Andrea Enria, the ECB Supervisory Board Chairman, speaking to Bloomberg. Now, meanwhile, Germany is entering a hard lockdown today, closing non-essential stores, urging offices to shut. The Chancellor, Angela Merkel, is warning the country faces a new peak of COVID-19 infections next month. It's raising doubts that the country's lockdown will end in early January as planned. Well, still with us is Ludovic Subran from Allianz. Ludovic, a number, actually, of questions on not only European Central Bank, but, a possible third wave of infections and what these lockdowns are doing in Europe. Are you less bullish on Europe than the US right now?
We're slightly less bullish indeed, but because of the uncoordinated stop-and-go policies, what you see now is it's not only, the second wave or the third wave, is that countries are actually doing it in a very haphazard way, which is very costly for Europe, for, people going for their subsidiary to the other subsidiary, for, holidays, skiing in some countries that are forbidden. So my concern now is a bit this chaotic moment. We are very worried on Brexit on one side. We have this, domestic lack of coordination. So Europe went bold and went big in announcement, but now it's all about spending that money. We're still missing some plans from Italy, Spain when it comes on what they want to spend the money on. So that's the only reason why we are less bullish on Europe, is it takes 27 times longer to agree on something than in the US.
When you look at the recovery fund, Ludovic, how much of a real game changer is it for Europe? What more do you need? And I may ask you about Brexit, but what more do you need to see in the next 5-6 months to make sure that Europe is actually on a stronger footing?
Well, as I said, we need to make sure that some of the countries that have not labeled the way they're going to use the fund do it stat, so that we don't have any politicization of the disbursements in this fund. It is a major breakthrough. I'm very happy about this recovery fund, but we still need a plan in some countries on how they're going to finance it, because the real risk is lowballing this recovery, especially when you look at how much the US is going for. They very strong for the stimulus, and we need the countries in Europe to do that with the help of this money that is deconsolidated from their own balance sheet. So we need plans, and we also need to make sure that we continue to talk, because the real risk is policy mistakes, is having this, desynchronized way of recuperating, or having yet another border, closure in some of the countries. And as you know, trade is of the essence here. Trade has been rebounding very fast, but who is gaining the most from the trade rebound? China for now. So Europe absolutely needs to make sure that the competitive edge is kept, and for that we need to have as much fluidity as we can in the European single market. And of course, the job market is also very important. Unplugging the partial furlough measures and without creating a major surge of unemployment and therefore social risk is very important. This is very local, but to a certain extent, it is also something that will have to be decided, in Brussels and certainly in Frankfurt in part. So vaccine, unemployment furlough, unplugging, and this trade reopening, and avoiding, that everybody does their own, just because their epidemic dynamic is very different from one country to the other.
Ludovic, what is a policy mistake actually from the ECB look like right now? Is it too much or too little?
Well, the ECB has been, for me, they should get the Nobel Peace Prize of 2020 because they've been really strong at making sure we keep the euro. Just remember where we were 10 years back and how we were finger-pointing everybody. Today, we're not finger-pointing, but of course, 2021 is yet another game to play. I think the ECB has done the right thing by extending the envelopes. I think they have a big issue on their plate, which is the Faustian pact with the banking sector. I just heard you about this bonus, and I think Enria said something that we cannot continue to play God forever. So I think the ECB has a problem with its transmission channel of monetary policy, which was going to be the banking sector, and what they're going to announce on that front is going to be pivotal for 2021. So I would focus the attention here. I'm not concerned about their being able to suppress any type of market volatility. I'm not that concerned about the euro dollar anymore. I'm not concerned about inflation in the Eurozone for sure. I think, and we avoid also the deflationary pressures, at least by doing a bit more. I'm really concerned about the banking sector, because with the abundant liquidity that has been injected, you have a record low, credit to deposit for the Eurozone area. So we are not in an extension of credit phase. Of course, the demand is very low, and this is a big issue, and this is certainly linked to the banking sector, its weaknesses, and the game of cat and mouse that we see between the supervisor, the regulator, and the banking sector.
Ludovic, there was, something that actually really caught my attention was also the Group of 30 putting this report out, led by Mario Draghi and Raghuram Rajan, saying that they worry about solvency, and this is the next big crisis in the making. And it kind of points to what you're saying. Is there a way of stopping the solvency crisis from taking hold now?
What is sure is that we know that this is the big risk, right? So compared to 2008, we avoid, we've done what it takes to make sure that there should not be any endogenous financial crisis. There shouldn't be massive externalities from the solvency crisis. But of course, there are holes everywhere. You have states like, zombie banks. You have companies in some sectors that actually have no future. Some of them have done great and coping mechanisms have worked. But of course, the liquidity crisis, especially in the corporate sector, could become a solvency crisis. We, forecast insolvencies, so corporate insolvencies, to actually increase over the period of the pandemic. So from 2022, over 2019 by 20%. But what we see is that we have record low number of bankruptcies across Europe right now. So it means that they're going to catch up at one point. And we have, for example, in France, an increase of insolvencies in 2021 by 30%, in Germany by 15%. And so this is, this may be needed to cleanse a bit some of these companies and get this cash out somewhere else, this capital, this labor somewhere else. But this is something that is, of course, very costly in the short run. If you don't have prospects, if the growth doesn't kick in, this could create a massive, domino effect. And we are particularly worried about some of these large companies in the service sector, hospitality, retail, that are in particular risk because they were already over-indebted. And because if they don't have, nominal growth, pick up in revenues in 2021, this is a lot of suppliers, employees, shareholders that are a bit on the grill. So this is a big issue. And I think this is why, the attention of policymakers is on this. Yeah. But we will see if it is as efficient as they promised. President Macron, I remember in March, said there will be no bankruptcy in France. What a very strong promise you make when you do that. Yeah?
Ludovic, thank you so much. Ludovic Subrander, way too alert actually for being a new father, chief economist at Allianz. They're letting you sleep too much. Coming up, we speak to the WEF managing director, Sadia Zahidi. That's in about an hour from now. We talk about global competitiveness. We'll also touch on solvency. This is Bloomberg. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now, the market's seeing a bit of positive momentum. First of all, unclear on the details, but it does seem that Brexit is going a little bit better than maybe it was just a couple of days ago. We're also getting some positive signs about stimulus in the U.S. Today, it's Fed. Coming up, our weekly show, ETF IQ Europe. We'll talk to strategists talking about cash levels and, of course, ETFs.
Another day of risk off across the financial markets. We bring you special coverage of all the price action and implications here on Bloomberg Television.
I was actually poor.
No foreplay?
Eat your bag of Lay's with a smile on your face.
If all the diseases have been taken, I'll take a tax.
Welcome to Bloomberg ETF IQ Europe. I'm Francine Lacqua, and over the next 30 minutes will be your guide to the region's thriving market in exchange-traded funds. Everything you need to know about the funds and the flows. Making history, a Vanguard equity fund becomes the first of its kind to top $1 trillion in assets. We'll discuss a race for lower fees. Flashing red, Bank of America strategists say a plunge in cash levels is sending a sell signal for stocks. We'll ask if the rally is set to take a pause. And a smart year for ESG. Green investing tops the 2020 league table for smart beta inflows. We'll bring you this year's scorecard. Well, first up, let's take a look at which countries and sectors have been attracting the money. Our Danny Berger has all of the details. Hi, Danny.
Hi, Francine. I've got FFLO up. So these are ETFs which track European regions. And for another consecutive week, it really has been the trend all month so far, is that the UK is topping the leaderboard, $522 million worth of fund flows. Look, the net flow from Europe was 521. So basically all of that being carried by the UK. Citi mentions that for December so far, ETF inflows are already on their way to topping what we saw in the record November. They think that this inflow really is due to investors who want to get into value stocks and more commodity-sensitive names. So that's certainly part of the reason why we're seeing the UK looking so popular for ETFs, despite the fact that this past week does capture last weekend when we weren't sure what the outcome of the Brexit talks would be. Now, speaking of value, we also saw net inflows into France and Germany as well over the past week. But to the downside, not all of continental Europe got inflows. Italy seeing outflows of $57 million, most of that coming from a BTP tracking ETF. Yes, Italy might be one of the few bonds that's still giving us a positive yield. Still, that yield near a record low, so perhaps investors not all that interested in owning a BTP ETF right now. Francine?
Danny, thanks so much. Our Danny Berger there with the latest funds and flows. Now, money managers overseeing more than $500 billion in assets are underweight cash for the first time since 2013. According to a Bank of America survey, investors are the most bullish towards risk-on assets, stocks, and commodities in almost 10 years. Strategists say the plunge in cash exposure is setting off the bank's sell signal for equities. Well, joining us today is Antoine Lenné. He's EMEA head for SPDR ETF strategy and research at State Street Global. Antoine, always great to speak to you, so thank you so much for coming on. When you look at some of what we'll see over the next 2 to 3 months, how different will 2021 be to what we've seen so far?
I think there's a bit of a sugar rush towards the end of this year. Clearly, what was different actually between Europe and the US is that the flows into value in terms of into cyclicals, into risk-on type of trades really came late in the game, just after the vaccine announcement, really. So for all of the buckets of risk-on trades, it's been filled with in the past months or past 5 weeks now. 2021 might be a bit different. I think the expectation for returns might be lower. The good thing, though, is that bond performance is expected to be even lower than that, so that still gives a little bit of a signal to be positive risk assets, equities. There will be some pockets of value to be found. But one thing that we believe at State Street Global Advisors is that the resilience of the market and investors will be retested as we go from maybe one wave to the next, especially in the COVID, crisis.
Antoine,
or in the COVID pandemic.
What happens to the rotation? Yeah, what happens to the rotation? How much more will we see that?
I think there's some room for rotation and some room for if PMI numbers were actually more positive than expected this morning, say for France and Germany in particular. So that's to some extent a positive in the continuation of the rotation. What we've seen in the last week is a little bit of a pause. Obviously, there were a few concerns. You mentioned Brexit, and it's good to see flows back into UK equities in particular. That's a place where, as you mentioned, I don't know if we call that a pure value trade or if we call that a trying to buy what has not been or what has not caught up yet with the rest of the market. I think we'd want to be a bit more careful about the value in the sense of the factor term, but clearly we continue to see some investors buying that. Now, for 2021, we still believe that the US and China and EM to some extent make sense in terms of allocation, even if maybe that might not be fully aligned with some of the European strategists in particular, who believe that there is value left in European stocks.
Antoine, yeah, what happens to fixed income in Europe and elsewhere in 2021, and how do you play it through ETFs?
So in 2021, we keep a long bias towards carry, so going long investment grade credit. To some extent, there's not a lot of fear of a kind of big duration move in the euro space. So the curve in euro should be relatively well anchored. The ECB is in the market. Inflation remains really lackluster. So there's even if PMI numbers were good, I mean, inflation is not a signal that a strong recovery is en route. And as a result, we're positive, being long investment grade euro corporate, being long US investment grade as well, and we would want to play tactically going long high yield through ETFs, of course, because they're an easy tool to get into the market. Going long high yield when spreads widen a little bit. So on a bit of bad news, this could be an interesting strategy to play. Other places, of course, which are quite important if you're looking for yield and for a catch-up in terms of performance, it's emerging market local currency in particular. So there still is a pickup to be had because of further dollar weakness. As a euro investor, and maybe as a sterling investor, because sterling is relatively fair valued at the moment, or even a bit expensive to some extent, you might want to hedge at least your cable or your euro-dollar exposure. I wouldn't hedge the underlying EM currencies, but I would hedge my exposure to the dollar and try to benefit from the good performance or catch up of EM currencies like the Brazilian real and the Turkish lira.
Antoine, overall, given the ETF market in Europe is so much smaller than the US, how much are you expecting it to grow because of what we've seen this year? There's been a lot of appetite for it. Does it double in the next 5 years?
I think we've put a paper back in September in terms of the growth, and I think we called it to crisis and still growing. The market in Europe, we were expecting it to maybe touch $1 trillion later in this decade. Clearly, doubling it by 2025 might not be a crazy idea, given the speed at which it's growing. Now, it is fair as well, and whether it's about fixed income or about equities, it is fair to say that the penetration of ETFs in investors' portfolio is lower than it is in the US. It is clearly still growing thanks to what we would qualify as institutional investors, rather than the more retail type of investors, because a lot of the ability for ETF issuers as well to sell through bank networks and so on is maybe more limited than it is in the US. So from that standpoint, the opening up of that part of the market will be good, but $2 trillion, should not be too difficult to get to by maybe 2025. We've got to be careful about making those forecasts, but that's in 5 years' time now.
Yeah, Antoine, when you look at some of the appetite for ESG, how much will this market grow? So if you're expecting, big growth for ETF, what's the part that ESG ETFs will play in that?
That's been the. I think if I were to remember three things about 2020, it's adoption of fixed income ETFs by a broader number of investors. ESG as a key signal of a tipping point or a turning point in terms of the flows. And if you're thinking about the acceleration of the number of products that have been launched this year, 60 or more equity ESG ETFs, close to 17, or let's say close to 20 fixed income ESG ETF in total. So I do believe that this is clearly the beginning of a trend. Obviously, the numbers are staggering in terms of flows. There's been a 100% increase in fixed income ETF flows from 2019 to 2020. We might not go at 100% again in 2021, but it would just mean gathering 6 billion in fixed income ESG ETF, for example. It's not like an unsurmountable task, I would say. So this is, in our sense, a strong growth market for the overall industry, and it has an opportunity to catch up quite significantly. Just sorry to focus on fixed income just for 1 minute, but if you're thinking about how small fixed income ESG ETF is across the globe, you've got roughly $1 trillion of assets in fixed income ESG strategies in the fund market. And the ETF is really, really small in this segment. You've got 15 billion in European domicile ETFs at the moment. So a lot of space to grow, in our opinion.
Antoine, thanks so much. Antoine Linné there, EMEA head for SPDR ETF strategy and research at State Street Global. Now, coming up, has a rotation into value run out of steam, or has it only just begun? We'll discuss that more and bring you your smart beta scorecard for 2020. That's coming up next, and this is Bloomberg. This is Bloomberg ETF IQ Europe, everything you need to know about the funds and the flows. I'm Francine Lacqua. Now let's take a look at which smart beta strategy have been gaining. Here's Danny Berger with your smart beta scorecard for 2020. Hi, Danny.
Hi, Francine. Look, ESG absolutely dominating the flows we've seen into smart beta so far this year. We've heard again and again people on the show come on and tell us it is a pivotal inflection point for ESG, and the flows really do back that up. Nearly 40 billion euros worth of flows going into European listed ESG funds so far this year. Previously, the record was 15 billion, and before that, we didn't see a year where flows topped even 3 billion. So the pickup in the past 3 years has been absolutely remarkable this year, driven even further by the coronavirus crisis as well as regulation. Now, the last two there, size and value, are really indicative of what's happened in the markets over the past few months, and that's this reopening trade. Hopes that you'll get domestic stocks to outperform as the economy recovers. That's that size factor there, betting on small caps. Value, of course, the underloved fund. I should say fourth on the list, so it didn't make it into our leaderboard, is Momentum. That still did not have net outflows, though its interest did start to wane through the second half of the year as we had that reopening trade. Now, looking at those who lost, multi-factor ETFs saw the biggest outflows. So these are ETFs that take things like momentum, value, growth, stick them all underneath one wrapper. Now, perhaps the reason investors are less enthusiastic about multi-factor this year could be because we've seen this big rotation. Maybe some people want to time it. It's difficult to do clearly when you own every factor. Now, in terms of other outflows, we've also seen dividends, for example, not do very well this year. Low volatility. Those are sort of the same sort of bond proxy play. Not very popular this year, Francine.
Danny, thank you so much. Our Danny Berger there with the very latest scorecard. Now, for more on all of this, let's go to Howie Lee. He is head of ETFs at Legal & General Investment Management. Howie, happy almost end of 2020. What are you looking at in terms of rotation for the next 3 months?
Good morning, Francine. And you know what, over the next 3 months, and actually probably very much likely into 2021, it's going to continue to be about ESG again. I think really we're just starting to scratch the surface. You saw Danny's stats there about how ESG really dominated the flows. And again, the investors continue to need to allocate to that. We see investors both on the institutional side as well as in the wealth management side needing to have more ESG solutions. So I think that's where a lot of attention is going to be. But I think the other side, if we look at equity still, is there are definitely opportunities which are still undervalued. A lot of the movements this past year has really been on the large cap stocks, and some of the mid cap and small cap opportunities are often not seen with the same kind of lens. So I think there's going to be a lot more focus in the new year on that, and I think that's where a lot of times the thematic portfolios that we certainly look at, that's where we see the attention and where some good value can be found.
Howie, do you think there's anything that's being mispriced out there?
Yeah, definitely. I think that's probably pretty obvious if we talk about some of the more expensive stocks. You kind of look at historical valuations, and I think a lot of investors over the past year have had to have a bit of a reset to see what stocks are actually worth. Even though certain stocks seem to be expensive, they continue to go up. Now, that being said, one of the key metrics that I think is very important to continue to keep an eye on is sales growth. And so, sometimes it's very important to look at other fundamental factors to see what's driving that. And I think 2021 is very much still the same. Got to look at how the underlying companies are performing.
When you look, Howie, at some of the news stories that are making the rounds, one is U.S. stimulus, the other one is Brexit. Whatever happens with Brexit, what does it mean for the ETF market in the UK?
Yeah, I don't think the Brexit's going to change too much on the ETF market. Most ETF providers have already gotten ready to essentially Brexit-proof themselves. So the ETFs will continue to trade on the London Stock Exchange as well as across Europe. I think where Brexit will present opportunities are very much for asset allocators to decide for themselves whether the UK market is actually of good value to invest in. And I think there will be probably quite a few people on the street that will think that that is the case. As it relates to US stimulus, again, we are in an environment where we will continue to see low rates. Again, that is why it's really important to understand the relationship between low rates and actually the valuations that we see in the equity markets as well.
Great. Howie, thanks so much. Howie Lee there from Legal & General Investment Management stays with us, and we'll talk a little bit more about all of this. Coming up, an equity fund has become the first of its kind to top $1 trillion in assets. We'll bring you more on that next, and this is Bloomberg.
Climate change is the defining issue of our time, so we've redefined how we cover it. With clear data and rigorous journalism, we rise to the scale of the challenge to reveal the breadth of possibility. We look at stories from every angle to provoke debate, spotlight solutions, and make sense of the greatest crisis of our generation. Bloomberg Green, solutions for a changing climate.
It is critically important that the markets stay open in this time, as opposed to trying to take breaks in the middle. I think that that'll just push off the situation a little bit, but actually could create other pent-up issues if you do close the markets.
This is Bloomberg ETF IQ Europe, everything you need to know about the funds and the flows. I'm Francine Lacqua. Now, an equity fund has become the first of its kind to top $1 trillion in assets. The Vanguard Total Stock Market Index Fund, which includes both a mutual fund and an exchange-traded fund, passed a milestone at the end of last month. It caps a record year for Vanguard and a record year for ETF industries. Now, globally, inflows are set to reach their highest ever level, with net flows topping $460 billion. Well, still with us, Howie Lee from Legal & General Investment Management. Howie, when you look at the news from Vanguard, what does it tell you about the health of ETFs in general?
Yeah, the ETF industry is only going to continue to grow. I think we've seen that trend line continue for quite a number of years now. And as more investors are looking for both simple investment solutions, diversified building blocks, that is really just highlighting the fact that the ETF industry is going to continue to grow, not only just in the equity space, but very much in the fixed income space as well.
Where do you see the biggest growth actually coming from? How we talked a little bit about rotation, we talked a little bit about ESG, but what will fundamentally change in this space in 2021?
Yeah, so 2020, we've seen on the equity side, the largest areas of growth were both ESG as well as thematics. And I think thematic investing continues to garner a lot of attention and interest in investors as they continue to consider how to evolve their asset allocation process. Another area for development in 2021 will indeed continue to be in the fixed income space. That's an area that we've been focusing on for some time and recently launched some funds there. And 2021 is extremely important because if you you look at the flows over the last 2 years, actually fixed income inflows had actually outstripped the inflows in from equities. So, there's lots of opportunities for investors to be found in fixed income. And I think more and more asset managers will very much be launching new products in the ESG fixed income space.
Harry, when you look at the active management space, certainly when it comes to ESG, how will that change the ETF space?
Yeah, so there's been this dialogue around active management and whether active management and ESG go hand in hand. But actually, it really depends on how index, or I would say asset managers that run index strategies approach this. Certainly at Legal & General, we're very keen on making sure, first of all, our products are ESG aware and have ESG integrated into them, especially as new products come going forward. But also more important is the ability to essentially vote with your, with your shareholding. As an index investment manager, you have the capacity to vote and make change and really promote good practices at the companies that you invest in. So, I don't think it's exclusively for the active management community. The index investment management community can also participate in that ESG kind of voting scene.
Okay, we're way too optimistic, Howie. Is there anything that actually makes you worry about the ETF space in 2021? Is it liquidity? Is it what could happen in the real economy with banks insolvency and the crossover to ETFs?
Yeah, so again, I always look at ETFs and mutual funds in the same way. These vehicles have been around for a long time. 2020 was probably one of the biggest tests for the ETF market as it relates to, especially on the fixed income side. We did see spreads widen, and that is, a concern for some investors. But as we had seen through April and March and May, as more investors understood why those spreads widened, it was really to recognize the underlying markets for those bonds. The spreads of those bonds have themselves widened as well. And so I think what we're going to see in 2021 is, if there are spreads widening, actually investors fully understanding why that is and recognizing that what the ETF vehicle is doing is actually giving real-time price transparency of the value of the underlying holdings.
Howie, if there's one thing that you want to be invested in ETFs in 2021, what is it?
I'm probably going to say thematic ETFs. For me, it's all about focusing on the long-term growth. And there's so much uncertainty out there, right? We've had a very difficult period in society in 2020. 2021, you asked me about Brexit earlier. What we do know is that the world is shifting. It's going down the digitalization route. We are seeing more efficiencies come from automation and healthcare innovation, and of course, e-commerce logistics. And so for us, kind of looking forward is to identify those long-term growth opportunities. And I think going back to your question around ESG, sustainability will definitely be a key area.
Howie, thanks so much. Howie Lee there, head of ETFs at Legal & General Investment Management. Well, that's it for this week's Bloomberg ETF IQ Europe. We'll be back with more next Wednesday, 9:30 a.m. London time. And this is Bloomberg.
another day of risk off across the financial markets, we bring you special coverage of all the price action and implications here on Bloomberg Television.
Stimulus before Christmas, while Mitch McConnell says lawmakers are getting closer to a deal, investors await guidance from the Fed on bond buying. Extending restrictions, New York City's mayor says prepare for a shutdown after the holidays. France imposes a curfew. London's tighter measures go into effect. And urging a moderate approach, the ECB lifts its ban on bank dividends but imposes strict limits on payout levels. Well, good morning, everyone, and this is Bloomberg Surveillance. I'm Francine Lacqua in London, Tom Keene in New York. Tom, Fed, a bit of optimism actually also on two fronts. Firstly, it's the stimulus deal in the U.S. We could get something, at least by Christmas, and a bit of optimism, though, on Brexit. I'm not clear on what, Tom, if I'm 100% honest, because there's various things saying, you know, the UK is caving in on fisheries, and no, they're not, but the noise coming out of the negotiations is a bit more positive.
Well, the noise seen in the last hour and a half has been the economic data out of Europe. It has been stunning, Francine, and we break out today to new dollar weakness. This will be one of the major themes across the Bloomberg day. We see dollar weakness, euro up, blowing through 122. It's not that it happened, it's the way it happened. Francine, in the last hour, there's been a shift in the foreign exchange market.
Yeah, we need to spend a lot more time on that, Tom, but you're right. It's the pace, actually, of change that could worry a lot of policymakers. Now, let's get straight to the Bloomberg. First word news in New York City is Karina Mitchell. Hi, Karina.
Francine, good morning to you. Republican leaders say there's been progress in talks with House Speaker Nancy Pelosi on a stimulus package. House Republican leader Kevin McCarthy says, quote, there is a possibility of getting it done. No word yet whether Pelosi and Senate Democratic leader Chuck Schumer have agreed to set aside the two most contentious issues. Those are aid for state and local governments and a coronavirus liability shield for businesses. It was a pivotal moment on Capitol Hill. For the first time, Senate Majority Leader Mitch McConnell recognized Joe Biden as the winner of the presidential election. He's also discouraging Republican senators from joining any move to object to the Electoral College outcome next month. That's when Congress convenes to formally count the votes. And Fed Reserve Chair Jay Powell and his colleagues are considering whether to change their bond buying program to provide more support for growth. Fed policymakers wrap up their two-day meeting today. They're likely to offer new forward guidance on bond buying as the coronavirus outbreak spreads. In Germany, Chancellor Angela Merkel has raised doubts that the hard lockdown that begins today will end in early January as planned. Merkel warned that the country faces a new peak of coronavirus infections next month. The new lockdown will force non-essential stores to close. Employers are being urged to shut workplaces, and parents were asked to keep children away from school. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg. Tom.
Karina, thanks so much. Let's look at equities, bonds, currencies. The litmus paper of the system is the dollar. I'm going to blow this up because I don't even know if the boards are accurate right now in terms of what I was looking at an hour ago. Futures up 9, Dow futures up 60. The VIX from 23 comes into 22.43. That VIX ought to be a lot lower given where we are and maybe given the enthusiasm of a Fed day. The dollar index threatens 89. That's a huge deal. That's a major currency weighted DXY at 90.6. 91.16, and it's not that it's at 91.16, it's got there quickly. Below it, the Asia index, ex-Japanese yen, it's unched, but that's been much stronger as well. Francine, all through surveillance today, we're going to have to pay careful attention to the reaction to those great PMI statistics out of Europe.
Yeah, so if you look at the PMIs, look, manufacturing again was a standout, although there was also a marked improvement in the services reading. If you look at, employment, it fell in the euro area this morning. Job shedding slowed. German private sector employment resumed its decline this month. But remember, Tom, these are also figures before the latest lockdown, certainly in Germany. So just take it with a pinch of salt. But overall, there's just seems to be much more positive news. And you can see that filtering through European stocks, getting some 0.8%. So that's partly PMIs. It's partly Brexit, but also stimulus in the U.S. that's filtering through here. And then I wanted to show you a couple of other things. We had treasuries, but I took it out. Thank you, Olivia, for that. We took out treasuries, but it's all about the Fed and what they will do. So there's a lot going on this week. Joining us now to talk about everything that's going on, Sam Finkelstein. He's at Goldman Sachs Asset Management Co-Chief Investment Officer for Global Fixed Income. Sam, first of all, good morning. When you look at fixed income, what happens to European yields from here until mid-2021?
Well, it's not going to be very exciting. I would expect yields to roughly be unchanged. I think there's more dynamic stories elsewhere in terms of, Fed, what they're going to do, fiscal, but, Europe is obviously going to be on hold in a very flat yield curve with negative rates continuing into the future. It creates opportunities in other markets, but trading European bonds, not very exciting.
Okay, we'll get onto the Fed in a second, because I know that this could see some moves in terms of bond purchase program today. But Sam, when it comes to Europe, is the ECB fully in control of the yield curve? And how problematic is it when they let go a little bit?
Yep. So, the ECB is in control of the yield curve. They have been in control of the yield curve. I think the instrument, or the financial instrument, they're probably not in control of is the euro. And so the euro has been strengthening versus the dollar. That's tightening some financial conditions. Christine Lagarde mentioned it, but they do not have the tools to halt a currency appreciation. But I do believe they have the tools to control the bond market.
Sam, Tom Keenan, New York. Wonderful to have you with us today. I love the idea that you were a foreign exchange trader at UBS years ago. That's the idea of losing the bid in 3 seconds always is an educational experience. Let's get educational on price up, yield down. The great unseen for 2021 is a path to ever lower interest rates, opposite clearly of consensus. What will be the vehicles, the processes that will force price up and yield down for the United Kingdom and the United States?
So price up, yield down in actual government bonds, I think is going to be challenging. I think there's, one thing, a couple of things we can almost know for certain, and that next year there is going to be a material economic recovery, given the positive scientific developments. And I think the big challenge for central bankers is how do you keep financial conditions loose as the economy recovers? And so there's going to be pressure for nominal yields to rise. And the intent, I believe, of the central bankers will be to keep conditions loose. They buy assets, they give forward guidance, they have a number of tools. I think the yield, at least the nominal yield lower story, is unlikely to happen with the economic recovery. But what policymakers need to do is ensure that there's not a disorderly rise in yields, a rising of real rates that that end a sharp recovery.
Well, this is fascinating. This goes to your mathematics at Yale, which is, do you do this with stability? I mean, we talked to Peter Orszag about this yesterday, and there's a presumption that they have the tools available to provide stability while they go through this exercise. Says who? What's the likelihood of unstable outcomes?
So listen, there's always tail risks. There's always sharp, the potential for sharp moves, in financial markets. We live in a world with fat tails. What is the central bank playbook when those tails emerge? And that is expand the balance sheet and buy assets. And at least we know in many markets this is very effective. And so I think that will be the playbook throughout 2021. And, you know, it will be nice to have an economic recovery. Central bankers will welcome an increase in inflation. And, you know, if things get disorderly, then I expect to see, you know, asset purchases.
Sam, are we looking at a global, Sam, are we looking at a global solvency crisis? And if we are, what are the things that central banks can do now to avert that?
So, you know, with respect to a global solvency crisis, I think the answer to that is, you know, absolutely not. And when you think about a country's ability to pay their debt, it's the level of debt. It's also the cost of debt. And, you know, in coronavirus, almost every central bank, you know, barring a couple problematic emerging market countries, have been able to cut rates. And so the actual cost of having such a large debt burden, you know, is very modest. Not a lot of inflation pressures, no evidence that inflation will rise sharply. And so while the levels of debt are high, the cost is very low. Real yields are negative. You know, Germany's issuing at negative nominal yields and negative real yields. And so no major solvency issues, barring, you know, a couple of more challenged countries in emerging markets that, you know, have the challenge that yields and the cost of interest go up, not down when there's a crisis.
So, Sam, we'll get onto emerging markets in a second, but overall, you know, given what you've just said, where do you see the biggest opportunities but also challenges in 2021?
So one challenge as a fixed income investor is we like income and yield, and we can get that income we can get that yield in various ways. You can buy longer duration government maturities. You can buy credit. You can buy, you know, agency mortgages. And so the question really is, what is the most attractive way, you know, to get some of that income, you know, for our clients? Right now, I would say there's two assets that we like, and that's high yield. And the reason to like high yield is high yield has lagged investment grade credit. We do expect a cyclical uptick in economic activity, and, you know, high yield is a more cyclical asset. So good opportunities in high yield, very healthy issuance in December, record December issuance for high yield companies, you know, creates opportunities. And the other asset we like is agency mortgages. Now, this is not a cyclical asset. You're not taking credit risk. But when we think about the Fed is going to almost certainly continue buying $120 billion. And the technicals in the mortgage market, you know, are very good with the Fed active.
Well, some of the details there with Sam Finkelstein, and we will continue. We really want to quiz him on EM and the opportunities there, less focused on, to say the least. We focused on futures up 9, Dow futures up 62 this Fed day. An interesting soup of issues for Chairman Powell. We'll check in with Randall Krosner of the University of Chicago, and of course a former Fed governor. That's sure to be a smart conversation. Stay with us. The dollar weaker this morning, euro 122 flat. This is Bloomberg.
We have some good news in terms of vaccines and a chance to overcome the health crisis, but we are not there yet.
We need the fiscal stimulus, and we need it relatively quickly, because I can see where the second wave's coming. You can see consumer spending beginning to get impacted again.
What we need surveillance to be stronger. We need public health measures, because you have no other way at the beginning. This is your best weapon, and you need to use it well.
The good news is that both the vaccines and the therapeutics, in particular the antibodies, are coming along and will start to bring that number way down.
We don't just need more investment in public health. We must also rethink how we value health.
I do believe a targeted fiscal stimulus is going to be in order to really begin a more equalized economy.
Surveillance. Good morning, everyone. Francine Lacroix in London surviving a birthday. Tom Keene in New York. There was no birthday for me. We went in the morning on that as well. Futures up 10, Dow futures up 65, and the dollar weaker off really sparkling economic data in Europe. It was a surprise, almost a jump condition. Let's look at a chart here. This is Asia DXY, not the DXY index, not the Bloomberg Dollar Index, but the Bloomberg JP Morgan Index, showing the recent bout of Pacific Rim strength ex the Japanese yen off of the massive financial crisis of 1997, and then on we go to a stronger Pacific Rim. And a leg up here right now. Sam Finkelstein with us of Goldman Sachs, away from foreign exchange, but nevertheless part of the mix in EM as he looks at fixed income. Sam, the fact is it is a dollar week trend. You mentioned that in your note. And there seem to be real dynamics in EM, and particularly on the Pacific Rim. How do you advantage from stronger Pacific Rim currencies?
Yep. And so, what are the forces that are driving the dollar down this year? One, valuations are expensive. Two, the U.S. has amongst the most negative real yields in the world as a function of having rates at zero with higher inflation. And also some concerning fiscal. And so, we're looking at a dollar down overnight. I think that's driven by some good flash PMIs out of Europe.
Yeah.
As well as going into a Fed, but also some optimism on a fiscal agreement in the U.S. Now, in particular, when we look at some of the Asian currencies, almost all of the North Asian countries have a current account surplus. They've also handled the coronavirus, tremendously well, and you're seeing higher domestic activity as a result. That obviously benefit from a recovery in 2021 with their exports. And so, really, a very good story, to play, pick up yield, safer with the current account and better economic activity. It's really nirvana. So
right,
really the
there we go.
What is the pace?
That's what we like. Jan Hatzius loves when the fixed income desk talks about the nirvana trade. The problem with that, Sam, is everybody's on board. Are you worried that the trade is overplayed right now?
Listen, we always need to be, concerned about, positioning, whether that's in rate markets, whether that's in credit markets, or currency markets. Just because the trade is crowded doesn't mean, it's the wrong position to have. I think one of the challenges is when you're long credit or you're long an EM currency trying to capture that yield and you close the position, what do? You put the cash balance at zero or negative in Europe, and that's not much fun. And so you end up getting pushed back in, to market. And so I think it's important to build a diversified portfolio with income and, keep your positioning such that you're able to take advantage of dislocations.
Sam, what do you put in that diversified portfolio?
So, in terms of what we think are the better opportunities going into year end, we like U.S. high yield. That's really the cyclical theme with an uptick in activity given scientific developments. We like agency mortgages, a very, very good technical position with the Fed continuing to buy securities. Housing activity tends to slow in the tail end or in December. So very good technicals there. We like the dollar down theme, versus select, emerging markets and G10 currencies. All of those, add some income, in a prudent fashion.
Sam, when you look at, I guess, some of the questions out there when it comes to, China, PBOC, and trade, how do you play that from, in your world?
Yeah. First, a new administration in the U.S., think, international policy will change. Obviously Biden, I think, is going to be tough on China, Russia, Turkey, but we'll take a different stance. And, I think in particular with China, likely to try to engage in a dialogue first. Another issue impacting, Chinese markets are some of the sanctions that Trump has announced at the tail end of his administration in terms of the ability to hold a number of SOE companies, and that can impact the debt markets. But Biden's going to have a lot to do and a lot to repair, and not expecting any major tail risk at least in the first half of his administration.
Sam, one final question. I think it's so important. You mentioned the Nirvana trade of the North Asia yield there. Everybody's on board. It makes common sense as well. And part of it is hello, how low can the dollar go? These nations are going to push back against that ever weaker dollar as their currencies go ever stronger. How will that roil your fixed income space?
Yeah. And so, when you think about, a central bank pushing back, they can intervene in currency markets. They can cut interest rates. They can use verbal rhetoric. They can encourage, outflows. However, when you think about China, what they're trying to achieve, China does not want a credit boom. The economy is doing fairly well. We're expecting 10% growth in China next year. And so China is not going to want to ease monetary policy aggressively and create a bubble. And so, they may be concerned about the pace of appreciation. I think they have somewhat limited tools to actually control it. And when we think about valuations, we should also recall that the dollar started the beginning of 2020 at very expensive valuations on a historic basis. And we've seen some normalization, but I do not think the dollar is cheap by any means. Probably approaching fair value on a number of the metrics that we look at.
Sam, thank you so much. Goldman Sachs Asset Management Co-Chief Investment Officer there for Global Fixed Income, Sam Finkelstein. Now, coming up on Bloomberg Markets, European Close, Dwight Scott, Blackstone Credit Global Head. That conversation coming up 4:30 p.m. in London. That's 11:30 a.m. in New York. And this is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Are you worried that people won't take the vaccine?
we remain concerned about vaccine hesitancy.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This is Bloomberg Surveillance. I'm Karina Mitchell with the Bloomberg Business Flash. Two of the best-known names in the cannabis business are combining. Canadian-based Aphria is paying a 23% premium for Tilray. The new company will have an equity value of about $3.8 billion. It will trade under Tilray's ticker on the NASDAQ. Meanwhile, online retailer Wish raised $1.1 billion after pricing its IPO at the top end of the market range. That gives Wish a valuation of about $17 billion. So far this year, IPOs on U.S. exchanges have raised more than $174 billion, a record. And that is the Bloomberg Business Flash.
Karina, thank you so much. Greatly appreciate that. Let me do a data check right now. Futures up 11, and they advanced. Do I want to say melt up today? I don't think so. But a real constructive tone to the market. The Dow Jones Industrial Average Futures, 30,200-ish, about 100 points below a record trading high. The futures there up 76. The VIX 22.40. But the real news is in the foreign exchange space. We had a 122 on euro. Right now, there it is, 122 flat again. And yen, 103.32, shows that weaker dollar against the major currencies, and of course, seeing it to an extent in EM. Renminbi 6.5294 really gets my attention. It is an historic 2020 on to 2021. We catch up with the World Economic Forum, Sadia Sahidi. Next, this is Bloomberg. Good morning.
Retirement is confusing. That's one reason why 42% of people age 18 to 29 have no savings, and partially because of things like student loans and other priorities like just being able to pay rent. But if you do have the means to save it all, here are some ways to get started.
First, there's the one everyone thinks about, which is your 401k. This is a savings account that lowers your taxable income because you don't have to pay taxes on the money you contribute. The downside is that when you take that money out, you have to pay taxes based on the income bracket you're in at retirement age. But there's one major benefit to your 401k. Employers often offer contribution matching, which means essentially you're getting free money. Another option is the Roth IRA. With this, you pay taxes now on the money you put in. This gives you a savings account you can withdraw money from at retirement without having to pay taxes on the money you take out. You can only put $6,000 a year into a Roth. This is also a great option because with a traditional 401k, you may have to pay a penalty if you have to cash that money out early, but that's not the case with a Roth. Most financial experts suggest a combination of the two if you're able. To save more and worry less, you can set up automatic transfers into a savings account from your regular bank or credit union. Tools like Betterment can also help you set up automatic payments into a Roth IRA so that investing can be simple and mindless.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
Give you a sense of the real-time action, the 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
This is Bloomberg Surveillance. I'm Francine Lackman, London. Tom Keene in New York. Now, Tom, we all know this year the World Economic Forum has suspended its Global Competitiveness Index. Instead, the forum has just released a special report examining how the recovery from the COVID-19 crisis can build productive and sustainable economic systems. Now, the report lists Finland, New Zealand, Switzerland amongst the top economies that are best prepared for future economic transformation. Well, joining us now is Sadia Zahidi, World Economic Forum Managing Director. And Sadia, I know you've been extremely busy during this time with the reports and trying to, give world leaders an impetus on how to rebuild better. So thanks for everything that you're trying to do. Where is the U.S. in this? Where is the U.K.? And is there a danger that these old Western economies actually fall behind in rebuilding better and quicker?
Yeah, it's exactly to prevent this kind of falling behind from all economies that we're working on this method of looking at the 11 key priorities for economic transformation. It's become so cliche to talk about we must have economies be more inclusive and more sustainable, and that is correct. But what are the actual policy priorities we should then focus on? How do you make these things endogenous to economic growth in the future rather than simply dealing with the after effects of planetary degradation or inequality? So that's what we're trying to do. In terms of the United Kingdom, the UK does fairly well in terms of having put in place some of the priorities around the energy transition. It does fairly well in terms of social safety nets. It does fairly well in terms of developing labor laws for the future, but that's all based on today's data against these future priorities. In terms of the United States, it does fairly well in terms of having put in place investments for the markets of tomorrow. So really investing with the public sector and the private sector into greener energy, into markets related to ed tech and reskilling, into space exploration, et cetera. So all of these things that are needed in the future, but lagging behind very much when it comes to social safety nets, lagging behind in terms of reforming education, lagging behind in terms of the green energy transition, and lagging behind in terms of antitrust laws. So there's a number of areas where, as you said, the advanced economies, Western economies in particular, need to think differently if they want to remain competitive in the future.
Sadia, you keep on talking about reviving and transforming, and I wonder when the perfect timeline for that is. Is it when you're still in the crisis, even in the middle of lockdown? Because if you wait too long, then you miss the boat.
Yeah, I mean, if some of these measures are not put in place now, we ossify the structures that exist today. We kind of ossify the market concentration that has grown, we ossify the inequality that's growing, and we basically make it much harder to deal with environmental sustainability in the future. So this is very much the moment, and we sort of look at two timeframes. There's a reaction to the crisis, certainly, but then there's a revival phase, and that's the next 1 to 2 years. And then there's the economic transformation phase, which is the next 3 to 5 years out. And we lay that set out what you need to do today, which most governments are doing already, and then what needs to happen over the course of the next 5 years.
Sadia, Tom Keene in New York, wonderful to have you with us. I've got like 8 questions, as always, off your report. And one of them is that time of year, which we're not doing, where I talked to the World Economic Forum about a panel. To fold into your competitiveness, to me, it's about the pandemic partition. And whether it's your Pakistan or the United States of America, there seems to be a massive competition partition between the haves and the have-nots of this pandemic. How are we going to close that? Not nation to nation, but within a given nation, if it's the challenges of Pakistan or the challenges of America.
Oh, no, absolutely. When we looked at the shorter term, it was very clear that the economies that were relatively resilient were the ones that had already invested in digitizing their economies. And within countries, there's huge amounts of polarization. To your point, there's a huge amount of the haves and the have-nots along the digital divide within a country like Pakistan or within a country like the United States, and then, of course, across countries. So the next big phase of recovery, and in fact, that's one of the 11 areas of transformation that we point out, there has to be greater digital infrastructure available to everyone. And that really does mean everyone, because without that, people are simply not going to be ready for the new economy.
This is a sort of a philosophical question. I'm going to go to your Smith College economics on this. Do we go back to our Lockean individualism in the Western world? Or is this pandemic enough where we actually shift to what Klaus Schwab talks about, which is a more inclusive social safety net?
I think we have no choice but to do that. As the pandemic has just shown us, we are only ever going to be as good as sort of the weakest link in the chain. And so if this pandemic exists anywhere, it's actually everywhere. And so when it comes to vaccine dissemination, when it comes to debt relief, there will need to be much greater coordination from advanced economies. And I think what we saw in 2020 is that there was a lot more of that national inward-looking focus. Global cooperation was missing. But in this next stage, there's no choice but to return to a form of global cooperation and multilateralism.
Sadia, thank you so much. Ms. Zahidi with the World Economic Forum, we thank her for an update there on the many themes that they're studying of this pandemic. With our first word news in New York City, here's Karina Mitchell.
Tom, thank you. Republican congressional leaders are optimistic about reaching a deal on a stimulus package. Senate Majority Leader Mitch McConnell said, quote, "We're getting closer and closer." McConnell and other top Republicans spoke with House Speaker Nancy Pelosi and Senate Democratic Leader Chuck Schumer. No word if Democrats have agreed to set aside 2 of the most contentious issues, aid to state and local governments and a liability shield for businesses. Meanwhile, not all states were hit equally hard by the coronavirus pandemic. California now says that despite the economic collapse, the state is poised to pocket a windfall of $26 billion. Tax revenue is coming in at a clip that no one had expected. That's thanks in part to the booming stock market. New York and Connecticut have similar stories. The new windfall could undercut the push for more federal aid. Healthcare workers who received a placebo during the Pfizer vaccine trials will have access to the newly authorized shot. Many are already taking up the offer. Placebo groups provide a critical point of comparison in gold standard clinical trials. And Joe Biden is breaking a barrier by naming Pete Buttigieg to be transportation secretary. The former mayor of South Bend, Indiana, would be the first openly gay cabinet secretary. He ran for the Democratic presidential nomination and won the Iowa caucuses. Global News 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg.
Karina, thanks so much. A nice lift to the market. Futures up 11, Dow futures up 81, a persistency to the market. I'm watching Euro to see if we see further Euro strength. Not quite there yet. All of that a backdrop to an interesting, nuanced Fed day. This December meeting, very different than the typical sleep fest. That will not occur today. Scott Minerd assists with Guggenheim Global. Thrilled that Scott Minerd could join us on our Fed coverage with Caroline Hyde. This is Bloomberg. Good morning.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
We are enabling banks to pay within a certain threshold, so within a so-called guardrail, and this is a change with respect to where we have been up to today. So it's an important opening, which has been broadly supported in the supervisory board, and which recognize that we are moving slowly back to normal, although we are not in the normality yet.
Andrea Enria, with a real interesting nuance there about compensation given good trading returns at banks in Europe. Jonathan Tice will translate for us. He is senior banks analyst at Bloomberg Intelligence and encyclopedic on the battle of EU banking. Are they going to cut bonuses or reduce bonuses, John Tice, simply because a regulator says so?
Good morning. Well, clearly, the fact that the regulator also sent out a letter to all the CEOs about pay proves they're reminding banks about the scrutiny. But in answer to your question, I don't think that they're necessarily going to kowtow quite to the extent that the ECB would like, particularly given for some of the bigger, stronger banks, they'll be a little disappointed at the sort of quantum of the cap on what they can return next year by way of capital.
John Tice, if JP Morgan runs in Germany or Paris, are they considered a European bank? Is the EU regulator telling American banking in Europe they can't compensate?
No. I think one of the issues, and you had Deutsche Bank, for example, talking about this earlier in the year, we know that the US investment banks have been taking market share. When the French had struggles with equities trading earlier in the year, there was a big shift in market share. And the bigger banks over here are going to have to pay up. And one of the things from the letter yesterday that was quite clear, they're saying, look, we recognize you may need to pay, you may have an agreement in place, but please consider deferrals and please consider other instruments, equity, etc., because we are watching. And it was very, very clear from the letter, we are watching. We don't want you to dent capital.
Jonathan, when you look at what the ECB has put in place in terms of some of the guidance compared to the Bank of England, why is the ECB so much more cautious? What are they actually worried about? Is it solvency? Is it the economy getting much worse?
Well, I think the PRA over here is kind of lucky, actually, because if you look at NatWest and you look at Lloyds, we've got very well-capitalized banks, whereas in Europe, you've got quite a few countries with banks that aren't as well-capitalized. And I think if you look today at the kind of the share price movements, the market's not overly surprised at the cap, but the banks that are the biggest losers are the Intesas and the Nordeas of this world, where because they're pretty profitable this year, we were expecting a higher payout, consensus certainly was, than is now going to be the case. They've been marked down a little. But you've got quite a sanguine reaction because I don't think this is entirely out of kilter with what the Bank of England's done. It's just that there are certain countries in Europe that have weaker bank systems, and the ECB kind of, as the overarching body, has to have a reasonably measured approach.
But, Jonathan, I mean, their thinking is that what they wanted dividends to resume to make sure that they were investable, which longer term makes these banks actually much more sustainable. But do they worry about the impact that, a delay to the vaccine or anything like that could have on their solvency?
Well, what they've said is, look, we've revisited our models and our visibility is much better now. And so we think our sort of original central scenario is more likely. So banks, yes, provided you can prove that you've got decent capital and a good profitability trajectory, you may begin to return capital. That all makes sense. But again, there are pockets of Italy, pockets of Spain. For the smaller banks, for example, I mean, we're not expecting capital return. It's the larger banks that this is really an issue for, the BNPs of this world and the INCs and KBCs and the Santanders. So it's still kind of a north-south, weaker, stronger debate. And when you've got a regulator trying to oversee all of that, you can understand why they need to err on the side of caution, perhaps more than the PRA, when you bear in mind we've got a Lloyds, HSBC, NatWest, even the Barclays, with an awful lot more capital now than would have been the case a few years ago.
Well, I got like 8 ways to go here, John, and not enough time. I just did a 3-year, like a bonus plan idea, 3-year total return of JP Morgan stock versus BNP Paribas stock, all in US dollars. And it's a stunning 1,400 basis points per year, John Tice. All you got to know, folks, is JP Morgan thumb up, BNP Paribas thumb down. Is there an urgency to move the stock price among bankers?
Well, I think one thing that we've been talking about is banks trading where they're trading in Europe. They'd be looking to do buybacks anyway. Why not do some buybacks and use some of that stock for longer-term incentive? Because if I was a banker, I'd rather be getting paid in stock that I thought had a chance of going up than look at UBS 10 years ago. It was trading at 4 times book. I know which I'd rather get paid in now versus then.
John Tice, thank you so much. Our senior bank analyst there. Really interesting. I'll tell you, folks, this is absolutely fascinating. The pernicious behind of EU on compensation. Really quite something. There's news out of Hong Kong where China has charged 10 Hong Kong activists over an attempted flight to Taiwan. This is breaking right now. We'll have much more on this. Of course, the uproar there has been extraordinary. We'll continue to follow this in the coming minutes and hours as well. This is Bloomberg. Good morning.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Good morning, everyone. Bloomberg Surveillance. Francine Lacroix in London. I'm Tom Keene in New York. Futures advance up 9, now up 12. Dow futures up 84. And the VIX surprises me, 22.31. I'd look for the VIX to come in with an abruptness. Good economic data in Europe, better than good, I should say, leading to stronger euro and to new dollar weakness. And we see that in the Pacific Rim as well. Right now, this is a great joy on space and on investment in space, on the rationalization of doing it again. Tess Hatch joins us out of Michigan Aerospace in Stanford, and then she went to the dark side. She went over to venture capital. Her parents said, "Are you kidding me?" And she lined up with Bessemer Venture Partners, one of the great extinguished venture capital firms out what was the first day like at Bessemer? I mean, you're wonky aerospace, laminar flow, spherical geometry, and you're in with a bunch of financial animals. What was the first day like?
A very common question I get asked is, how did you go from airfoils to term sheets? How did an aerospace engineer get into venture capital? And I like to say I'm still very much an aerospace engineer, but rather than being a technical engineer at a single company, I'm investing in the ecosystem and helping catalyze the industry forward by investing in technologies that I think will continue to push it and continue to open space for business.
We've just seen the Chinese space mission to the moon. We're doing it a different way as well. It used to be to the moon. It used to be to Mars. Explain how you go about the IRR analysis of putting something up in orbit around Earth.
Absolutely. And especially when you compare space to, let's say, software investing, where you change a line of code and you push it into the ether and you get your response. Space has more capital involved in a larger feedback cycle because you need to design, build, test, and launch assets into space to start getting your product and therefore generating revenue. However, the IRR and the return on investment thresholds that we put our SaaS software companies is the same that we do with our space companies.
Well, come on, you do it, but I know you're Smule. I mean, you guys are back in Smule, and I got to be out on there with their laps singing away like TikTok or whatever. This is serious stuff. How do you manage failure in space investment ventures?
Space is definitely a risky investment.
Yeah.
However, with time, as launches become more frequent, there's going to be room for some failure. Hopefully never, and we really never want any satellites to not work or any launch vehicles to not work. But ultimately, with time and ideally more satellites and more rockets, a few failures are inevitable.
Tess, what's a nanosatellite? And actually, is it worth, as an investor, do you invest in nanosatellites or do you invest in what launches these nanosatellites?
I invest in both launch vehicles and nanosatellites. Nanosatellites were the creation of decades of Moore's Law, which exponentially decreased the size and increased the power of commercial off-the-shelf electronics to allow for the invention of a CubeSat or nanosatellite. Why this is significant is because before the invention of the nanosatellite, the only way to get an asset into space was a massive school bus-sized satellite that would take years, if not decades, and tens, if not hundreds of millions of dollars to design, build, and launch. And the invention of the nanosatellite really lowered the barrier of entry to space. And my firm, Bessemer Venture Partners, has invested in the largest general purpose nanosatellite constellation, CubeSat, Spire Global, which I sit on the board of. And we have very unique sensors in space to help life on Earth.
What will happen to SpaceX? I mean, how has SpaceX almost democratized, how much people know and understand about space? And what does that do to investment opportunities?
SpaceX really is doing a fabulous job bringing space to everybody's attention, whether it's their Dragon cargo resupply missions to the International Space Station, or recently, Dragon Crew, where they had an incredibly monumental launch a handful of months ago, which was the first time in nearly a decade we launched American astronauts on American soil from an American private-made rocket. And they had a second Dragon crew launch as well. That was a massive success. So SpaceX really is leading the way, but there are hundreds of other space startup companies that are coming up in their footsteps. I'm confident will continue to push the industry forward.
Tess, one final question. I know Bessemer Ventures was the investment partner with the potato patch Matt Damon was growing on the movie The Martian a bunch of years ago. The reality is the romance of this is to the moon, like the Chinese recently, and the romance is to Mars. Do you envision with SpaceX that years out we have the rocketry and the desire and the technology to actually get to Mars?
I imagine a future where one travels to space with the frequency that we currently travel in an aircraft. And whether that's to a private space station in low Earth orbit, where our International Space Station currently is, whether that's the moon, whether that's Mars, I really do imagine that future.
Tess Hatch, thank you so much. Greatly appreciate it with Bessemer today on SpaceX and on where we're heading with investment within aerospace. Futures up 12, Dow futures up 81. Francine, the PMIs we haven't talked enough about in Europe, they were stunning.
Yeah, they were stunning, Tom. And again, just a word of caution. It is before the latest lockdown because the lockdown started in London just 2 days ago. In Germany, they also started a week ago. So just take it with a pinch of salt because it was for the earlier month. But certainly it's manufacturing that's powering ahead and it gives hope, about a recovery that's maybe deeper and more sustained. It does raise a question about inflation. I know a lot of people, maybe 80% think that inflation probably won't be a story of 2021, but 20 to 30% think it might.
I really take your point, Francine, on the lockdowns. And folks, this is important. All the focus on London, the focus on New York, the focus on maybe selected parts of America. These micro lockdowns in Germany, in South Korea, indeed in Tokyo, really, really bear watching. The sum of total of those lockdowns really could be really quite important. Again, futures up 12. Francine?
Yeah, coming up in the next hour, we talk, of course, about the Federal Reserve. We talk about the bond purchase program with Randy Krosner. He's University of Chicago professor and former Fed governor. We'll also talk about the specter or not of inflation, what this all means for central banks around the world. Tomorrow, it's also Bank of England, but today, it's Fed. This is Bloomberg.
It's such an interesting new world.
The world is changing.
For us, it's not about being first. It's about being the best.
While everyone is zigging, we're zagging.
We feel like we can maybe help people out more.
We have an enormous number of big ideas.
What we're trying to accomplish at Bumble is that you can drive profit and purpose, and they can coincide, they can coexist, and in fact, they fuel one another.
This morning, better economic data out of Europe. The euro and yen, they surge against the dollar. It finds new weakness. It is Fed Day. I am told Chairman Powell, he does not care about the dollar. Japan, Germany, even South Korea, well, they care about rising pandemic deaths. In New Mexico, well, they care about a 102% hospital occupancy rate. And, well, Senator McConnell, he says the Electoral College has spoken. President Trump says it is too soon to give up. Good morning, everyone. Bloomberg Surveillance. I'm Tom Keene in New York. Francine Lacroix in London as well. Francine, I need a Brexit update. Somehow we've gotten through the last 63 minutes without a Brexit update. How's that going?
It's going better, we think. And I think that, the crucial word is we think, because negotiations are ongoing, Tom, and you hear rumors that actually, there could be concessions on both sides when it comes to fisheries. But then you also have warnings, from insiders from the Commission. So I would say wait and see, but the move is a lot more positive, certainly than, it's more positive than it was last Friday.
It's unbelievable, folks. We're going to be doing this in February of next year. Guaranteed as well. I should point out sterling 135.03 for the gloom sterling crew. It has been a difficult 2020. With our first word news in New York City, here's Karina Mitchell.
Thank you, Tom. Republican leaders say there has been progress in talks with House Speaker Nancy Pelosi on a stimulus package. House Republican leader Kevin McCarthy says, quote, there is a possibility of getting it done. No word yet whether Pelosi and Senate Democratic leader Chuck Schumer have agreed to set aside the two most contentious issues. Those are aid for state and local governments and a coronavirus liability shield for businesses. Meanwhile, it was a pivotal moment on Capitol Hill. For the first time, Senate Majority Leader Mitch McConnell recognized Joe Biden as the winner of the presidential election. He's also discouraging Republican senators from joining any move to object to the Electoral College outcome next month. That's when Congress convenes to formally count the votes. And it is Fed Day, and Chair Jay Powell and his colleagues are considering whether to change their bond buying program to provide more support for growth. Fed policymakers wrap up their two-day meeting today. They're likely to offer new forward guidance on bond buying as the coronavirus outbreak spreads. And in Germany, Chancellor Angela Merkel has raised doubts that the hard lockdown that begins today will end in early January as planned. Merkel warned the country faces a new peak of coronavirus infections next month. The new lockdown will force non-essential stores to close. Employers are being urged to shut workplaces, and parents asked to keep children away from school. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg. Tom.
Karina, thanks so much. It's not a melt-up, but we're on the edge of that. It's a really nice lift to the market with real persistency in futures. Right now, futures up 12, Dow futures up 86. That may not seem like a big deal, but it's the way that it's up. It's got a real oomph to it. NASDAQ 100 out to 12,637. We're not out to record highs, but we're buttressed up against them. In the yield space, 0.1190, important to Chairman Powell, 0.92% on the 10-year. I'd really focus, though, on the currency market, euro dollar 121.89. And, to see some dollar weakness today is a big deal off that EU data. Francine?
Yeah, Tom, there's a bit more confidence in the markets. Of course, this is on the back of stronger Germany factory data, the confidence about the vaccine rollout and the prospect for more U.S. stimulus. Brexit also giving a bit of positives. Euro strengthening, the German 10-year bond rose, and then I'm just looking at crude oil because it's always a good idea to look at what that says about the economy. 47 points to 70, Tom.
Randall Krosner to join us here, the former Fed governor. Really looking forward to speaking to him about this financial system and our economics. Right now, well, the economics of our policy and our politics. Kevin Cirilli joins our Bloomberg chief Washington correspondent. Kevin, how will the president respond to the Electoral College? How will he respond to the gentleman from Kentucky?
Kayleigh McEnany, the president's press secretary, was asked about this yesterday at a press briefing, Tom, and what she said is that the litigation will continue and that they are going to continue to do so. But that's the political theater element. In terms of practicality, first and foremost, the transition briefings have already started weeks ago. There are binders that have been continued to be written for transition efforts at the various agencies and whatnot. And then from a longer strategic standpoint, Senate Majority Leader Mitch McConnell, I think yesterday, by adding another meeting with leadership on both sides of the aisle, including Secretary Mnuchin, that's what's on his mind as he continues to negotiate a fiscal stimulus, and it's down to literally the final hours.
Well, the final hour, it's not the final hour for Georgia, Kevin Cirilli, but it's off my radar. What's the sweat factor now on those two races? I saw some zeitgeist yesterday that the Republicans are actually really concerned about losing 2 Senate seats in Republican Georgia. Are they?
Yes, they are. And in fact, yesterday, President-elect Joe Biden traveling to Georgia in order to have a campaign-style rally and to really make this race a referendum on the two parties. He feels that he will have a much better chance at getting through his agenda should Georgia elect the, let's face it, much more centrist type of Democrats down in a deeply conservative state, a state, mind you, that the president-elect carried for the first time a Democrat has done so since 1992. But in terms of how that reality is impacting Senate Majority Leader Mitch McConnell, as well as Speaker of the House Nancy Pelosi, it really has been a divorced issue. Quite simply, they are facing pressure from their rank-and-file members who are eager to return home for the holidays with some type of fiscal stimulus package delivered for their constituents.
If there's a package, Kevin, where does the money go first?
Well, 3 things. First and foremost, progressives this morning are saying that they cannot get on board with any type of compromise unless there are fiscal stimulus checks provided in that. I would note that Secretary Mnuchin has delivered a message about a week ago from the White House that it was on board for about a $600 unemployment check in that regard. Secondly, vaccine distribution has become the new code word for aid for state and local governments. Democrats are hoping that Republicans might be able to sell that to some hardliners by saying that they're getting increased to state and local government aid, stay with me folks, in order to boost the funding for vaccination distribution. It's Washington translation jargon. And then thirdly and finally, I can't report on this enough, the centrists in both parties have really been trying to drive the political capital cards here. And you've got the Problem Solvers Caucus, which really, they'll be frustrated that I'm saying this, was a non-factor for years in terms of the Freedom Caucus and in terms of the rise of the AOC crowd on the left. Suddenly, they are the basis of this fiscal stimulus deal, and that could be a precedent-shattering moment. It's a new element in a new Congress that wasn't there after the 2008 financial collapse and the aftermath of that. And suddenly, with the new administration coming in, they are significant players in the debate in Washington.
Kevin, how's Georgia playing out?
Well, I think Republicans are nervous about that they would lose seats there. Democrats are optimistic, but they're the underdog, so to speak. John Ossoff, as well as Raphael Warnock, really trying to go in every which way that they can to defeat Senators Loeffler and David Perdue. But that's going to come down to the wire. And I know we always say this, I sound like a broken record, but it's really going to be turnout and whether or not the Democratic coalition in Georgia that elected President-elect Biden will turn out in a Senate race in a runoff in cold January.
Kevin, are the unemployed of America going to turn out on December 26 in protest against Washington?
Well, look, I think that there's no way to look at this in terms of the deadlines that expire for the unemployed on Christmas as another illustration of what has been an incredibly unprecedented, painful year for America's middle class and lower middle class. And the inequities of that. Yesterday on the Bloomberg terminal, there was a fascinating, horrific article about how this Hispanic community has faced unprecedented challenges in this second peak. So the pressure is mounting on leadership, whether it's Mnuchin, Speaker Pelosi, or Leader McConnell, and they have to, the repercussions of that will be felt